They could be valued at around $2 billion, so we'll watch to see if they decide to do that. And Eutelsat also in focus. This is a broader sort of slightly more featurey picture, but the new CEO has to secure funding fairly quickly to save OneWeb, which is seen as the possible alternative to Starlink. So we'll watch that one, Guy.
We certainly will. Let's talk about these markets. Let's talk about this open. It's time for the opening trade. Let's show you some numbers. I doubt they're going to be very exciting this morning. I think all eyes really on St James's rather than the city this morning. We're waiting for news to come out of these trade talks. What are they going to be? What are they going to deliver? How high actually is the bar in terms of sentiment and expectations around all of this? So the FTSE 100 is up by 0.1%. You've got the IBEX in Spain absolutely becalmed and flat. Stock 600 absolutely becalmed and flat. Nothing to see here. I think just there's a sort of tension. We're waiting. We need to see what that CPI print looks like. We need to see what's happening on the trade front. What is Besson going to say over the next couple of days? What are the data going to tell us? There's a lot of things happening right now, but we don't have the answers to all the questions that we're asking. Are we going to get the answers by the end of the week? I don't know. The market kind of, at the moment, doesn't know. There's no clear sense of direction. There you go. Look at that. That is a pretty uninspiring set of numbers that we are putting up on the screen in front of you right now. The FTSE 100 up by 0.3%. That could just be a mechanical factor around what's happening with the pound this morning following the employment data that we saw out at 7 o'clock this morning. So I think the market's asking questions, Anna. At the moment, judging by the numbers I'm seeing, there aren't many answers out there.
Yeah, absolutely. I mean, we're waiting for news lines around trade, aren't we? That's certainly a big focus for the markets. Mark Cardinal telling us on the Markets Live blog, he thinks the market has fairly realistic expectations around what this conversation at Lancaster House in St James's in London will deliver today. You point out the FTSE 100 is performing a little better than the rest. We're up around 0.3% there, and the upside is coming from energy names. So we have a little bit of strength coming through in oil prices this morning. We're up by 0.2% on Brent, and that means that by far and away the biggest points contribution this morning on the FTSE is coming from Shell and BP. Both of those together adding around 8 points to the FTSE 100. Yep. So that's, you know, the upside for what it's worth. Elsewhere in markets, we are pretty flat. As you say, we're pretty flat across much of the European space. The Stock 600 down just a fraction of a percent. Autos and parts is the best performing sector. That's up by 0.9%. Financial services, the worst performer, down by 0.7.
Energy stocks are up, but energy's priced in dollars, so the pound is down, so maybe that's a translation effect story that's coming through. UK house builders are up, actually. There's some maybe more positive noises coming out of the government on house building and kind of extra funds being set up maybe to support that sector. So that could be one of the reasons why I'm seeing Bellway up this morning. Barrett's trading a little bit higher as well. So that's certainly a story that is emanating from the UK right now. But elsewhere, it's unclear as to the sense of direction. What I am seeing is a bit of a sell-off in the defence sector.
Okay, well, that's certainly interesting. Certainly, given the conversation we had with Bill Al-Hafiz, he was saying that there's further to go on that defence play. Bellway, you mentioned the house price, the housing market, sorry, and Bellway put out a trading update earlier on today, raising their UK home sales guidance after a rise in deals, and that was something that Joe Easton brought to us a little bit earlier on. So we'll continue to watch that sector this morning as well.
Rheinmetall's got a volatility interruption, so defence stocks are down reasonably aggressively this morning. We'll get to the bottom of that, and we'll try and figure out exactly what is happening here. Let's get some analysis on what the bigger picture story looks like. Frédéric Carrier, Head of Investment Strategy at RBC Wealth Management, joining us around the table. Very nice to see you.
Good morning.
How are you feeling? There seems to be a lot of questions at the moment. What questions are you getting from investors? What do we need answers to in terms of the decisions we have to make?
I'm not sure we're going to get answers to anything, really. It's really an evolving situation. The trade situation is very important, certainly trade negotiations with China, but then with all other partners. And we think that the focus will shift away after this week to what will happen in early July when the 90-day pause ends. So trade is a question. The budget is another big question.
Yep.
And Section 899, how will that evolve? So there's a lot of questions and very few very clear answers. So we think we're evolving through a phase of uncertainty.
So what do you do? How do I get long uncertainty? How do I build uncertainty into my portfolio so that it works for me rather than works against me?
Well, you can, several strategies. You can have neutral positioning and really take advantage of big dislocation in markets when they do arise.
Right.
When volatility prices are relatively low, as they are now, you can buy a little bit of protection and really invest where you have only a lot of conviction.
And in terms of that conviction, one theme we continue to return to, Frédéric, is dollar weakness. And many of the people we talk to say this is a trend that's got further to go. Is that something you have a huge amount of conviction around? Are you investing around that?
So we think there is a cyclical downturn in the US dollar. We think that investors will seek to diversify their assets away from the US. The US economy is likely to weaken in the second half. So all this calls for some weakness over the next 9 to 12 months. We do expect a stabilization afterwards as yields in the US will be quite a bit higher than in other currencies, in the euro or Japan.
Yeah, that's the cyclical story. Do you see any structural signs to that story?
The structural story, we think that the dominance of the US is anchored, is going to stay. It might erode somewhat, but we do think that it will remain because there's no viable alternative at the moment to the US dollar. No other market has the depth of the liquidity required.
So for international investors, things like this 899 clause of the big beautiful bill that could make it less profitable for international investors to invest in the United States, you don't see that eroding the US investment case.
So it depends what the final language of the bill is. We do expect that there will be some changes. The financial lobby is working very, very hard. It is a powerful, influential lobby with a very good track record at getting things changed. So we do expect the language to be modified and certainly clarified.
What trends can we attach some degree of certainty to? People talk about the defence trade in Europe. It's getting hit this morning. I think there might be a note out, which is maybe a little bit more negative, coming from one of the big institutions. We'll narrow that down. But what trends can I lock onto at the moment? Does the AI trend still work? Does the defence trade still work? Kind of what am I looking at here that I can have some degree of visibility on?
For Europe specifically?
Generally.
Generally. Well, we'll start with Europe.
Let's start with Europe.
Yes. The fiscal impulse. So the fact that countries will be spending, Germany in particular, on infrastructure and on defense. These trends are there to last. And yes, there will be some weakness in the defense stocks. Defense stocks have done incredibly well for almost 2 years.
Yeah.
Retrenchment is normal. We would see this as a buy opportunity.
Buy on weakness? So I do. I buy on weakness.
You would. Yes. Yeah, we do think that there's further to run on this. So industrials which benefit from fiscal impulse, infrastructure, so some materials, some industrials. In our mind, the AI theme is very much, continues to be very valid, and eventually will go perhaps from a focus on semiconductors towards more adopters. But for now, semiconductors are still in place. And some banks, select banks in Europe, which will benefit from relatively looser regulation.
Yeah, tapping into that fiscal story, do you think that bond markets, will the vigilantes be to the fore when it comes to more defence spending, or will bond markets kind of go easy on European governments if they see sense in the increased defence spending, if it starts to become kind of existential for some European governments to spend more on defence? Will bond markets forgive?
So I think you put it very well. If it's spent sensibly, we do think that vigilantes will be relatively relaxed about the situation. It's the structural deficits at unopportune times. For instance, in the US, a fiscal deficit of 6.5–7% at a time of full employment, that might risk a little bit more scrutiny. Clearly, with us here in the UK, what Chancellor Reeves wants to do is going to be under focus as well.
But when you look at the US and US assets, it seems that bond markets are nervous around the fiscal side of things, and stocks sometimes are nervous around trade tensions, but have managed to make incredible gains despite all of the uncertainty around trade. I mean, we now know that I think that the new rate for US tariffs, US import tariffs, is around 7%, and of course that could go higher, couldn't it, if we don't see progress in US-China. For how long do investors sort of shrug that off, Frederic?
So we think that investors are a little bit too relaxed about trade tensions, certainly in particular with China and the US, unless the points of contention, which are at the root of tensions and which have been at the root of tensions for decades, unless those are really ironed out, it's very easy to see trade tensions flare up again. So we think that overall investors might be undercompensated for the risk that there is out there.
Just to kind of wrap it up, the US as a place to invest. Am I in a position now where, as a European investor, I need to rethink that? Is the America kind of first trade, is the America kind of exceptionalism trade that we've seen over the last few years over now? Can I draw, is that a conclusion I can take away at this point?
I think there are other opportunities elsewhere, whereas the opportunity set was very limited and has been very limited for a number of years on a geographic basis. There's a new opportunity set which investors would do well to pay attention to.
Okay. I'll take that as a yes. Thank you very much indeed.
Thank
Very nice to see you this morning. Frederic Carrier, Head of Investment Strategy, joining us from RBC Wealth Management. The Core Six is back. Switzerland and Copenhagen. Zurich and Copenhagen, let's call it that, are back open. Geneva, I probably should fold that in as well, as a result of which you've got some quite interesting trades happening. So Novo is up. UBS, though, is getting hit pretty hard this morning, as are defence stocks on the back of, I think, a Bank of America note. But I have limited details. Joe Easton has many more, so let's hand things over to him.
So Novo is indeed a strong mover, guys. You mentioned there, this coming from that story in the FT around Purvis Asset Management taking a stake. And as Anna mentioned earlier, a lot of that seems to be focused on the CEO and the new leadership at the company and how they could potentially impact the leadership at Novo Nordisk if indeed they do disclose this full stake. So Novo coming up around 2% at the moment. That stock down sharply, of course, from the highs that we saw last year. Then in terms of the defence stocks, we have got this note out from Bank of America, and seems to be having a big impact across the sector today. So BofA writing that they do not see room for a material re-rating in the sector today. They don't think there are extensive gains to come in the sector, and they do actually downgrade a couple of key stocks to underperform, equivalent of sell rating. So Saab over in Sweden, that one is an underperformer, and it is Renk as well. That one down 8%. Those two among the bigger decliners, but Rheinmetall was also weaker as well. Pretty much broad declines across the space, apart from a couple that BofA did say they continue to buy. That was BAE, one of those on the screen that was moving higher. So pretty much it's kind of the re-rating has gone too far, according to Bank of America. Then we've got house builders, several bits of positive news. Firstly, the Bellway trading update, that looked pretty good. Then we had the UK data, which was actually weak, but we've seen gilt yields coming down, the pound coming down as well, and therefore that is beneficial potentially for the mortgage rates. And then there was the additional stimulus news that Guy mentioned, potentially coming from the government around building houses and around meeting that target, similar to what we've seen in the past, but potentially all of those playing into that green screen for the sector. Then finally, beer and cricket in terms, well, I think I will do one more after this, but firstly, Diageo, beer and cricket, something I didn't expect to be talking about today. In fact, Diageo's Indian Premier League cricket stake potentially worth $2 billion. That's much bigger than I would have thought that is, but this could potentially help the Guinness maker reduce their debts. That's according to a note from Bloomberg Intelligence that is on the terminal. Check that one out. And then finally, as I say, UBS, Guy mentioned this one, hit pretty hard. Switzerland was closed yesterday for a holiday. On Friday, we got the news around UBS potentially having to have more than 25 billion in capital on their books following that takeover. Credit Suisse a few years ago, that was a big, keenly awaited decision from the Swiss government, and UBS does not sound particularly happy about it in their commentary. And the stock reopening significantly lower, down almost 6% for UBS in Zurich this morning.
Joe, thank you. Joe Easton from our equities team. Now, around an hour and 13 minutes ago, Guy, we got data out of the UK on the labour market. There's been something of a slow burn, it seems, in terms of the market taking this seriously. So the pound has been under pressure since we got that data, but it was quite muted to start with. Now we do see the pound down by 0.7% against the US dollar. And of course, we've had gilt markets opening up at the top of the hour. And we see quite substantial standout performance from gilts and yields coming down in the UK. Much bigger moves than we're seeing around the rest of Europe. So 5 basis points on the UK 10-year gilt, that opposed to around 2 basis points in the rest of Europe.
We're back to where we were on the, 29th of last month. We've been in a range for quite a while, so I think it's kind of widened the lens a little bit moment. But it does look like a fairly sharp drop, but we're definitely kind of back towards the bottom of the range that we've been occupying since, about the 26th, actually back to the kind of middle of last month. But yeah, it took a while to get going, and now I think maybe it was the reopening of the gilt market, which comes a little half an hour later than everybody else, that seems to have provided the catalyst. But yeah, we are moving lower. Is there now an expectation that the Bank of England can deliver what I think it probably wants to deliver, certainly? Yes. And that's lower rates.
We were talking about how that natural language programming tool that Bloomberg Economics has was picking up more dovish language from the BOE. Well, that would certainly chime with the latest pricing that we're seeing here. Traders adding to their Bank of England interest rate cut bets, pricing 47 basis points by year end, up from around 40 on Monday. So there we go. Huge moves.
Another 7 basis points being added on the downside.
Yes, that tips us into, that's nearly 2, isn't it?
The problem with the UK data is it's just, do I believe this? Should I trade on this?
Yeah.
Are we trading on that, or are we trading on the fact that the UK consumers tighten the wallet? I don't know at the moment. I think it's really difficult to determine actually what is happening with the UK economy, which has been much more inflationary than anticipated, more stubbornly positive, actually, that you could argue, than anticipated. But we've also got a spending review coming up, which that's the news tomorrow.
Yes. The retail sales picture, as you point out, overnight was pretty weak, but we pivot quickly in the UK narrative to the spending review, which is coming, as you say, tomorrow. So coming up on the programme, though, we will pivot to some of the other corporate stories we need to get across. Investors give a lukewarm response to a host of announcements on the future of Apple's products. We'll have more on the tech giant's struggle with artificial intelligence. That conversation next. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Welcome back. We are 19, I'm going to call it 19 minutes into today's session. Not a lot happening, waiting for a catalyst, looking for something to change the narrative. Does it come out of London in the form of the trade talks? Does it come out of the data that we are waiting for out of the United States, certainly tomorrow, NFIB today? So pay attention to all of that. In the meantime, we need to focus on what is happening in the tech sector, because actually there's a fair few things happening there as well that we want to be paying attention to. Apple unveiling its most sweeping software redesign yet, and we've seen big updates to its operating systems as well. This all happened at its Worldwide Developers Conference, which has been taking place in California. However, and this is a big however, very much unimpressing or failing to impress when it comes to more on the AI front. Take a listen.
As we've shared, we're continuing our work to deliver the features that make Siri even more personal. This work needed more time to reach our high-quality bar, and we look forward to sharing more about it in the coming year.
Yeah, Apple Intelligence feels like it's different to AI at the moment, and that's the problem. Matt Bloxham, Bloomberg Intelligence analyst, joining us now. No AI. That's the problem here, isn't it? There's a lot of shiny things happening here, but the market looked through it.
Yeah, I mean, obviously there is some AI, but it's a very different kind of AI to what we've seen from Google and others. Yeah. And clearly, from what you just said about Siri, there are lots of gremlins in the system for it to be something comparable to what the others have. But Apple's kind of very much gone down a different route to others on AI. And actually, we did a survey recently of US iPhone users, and over 40% said that they were very happy with the AI services they got on their iPhone, which compared to only about kind of 25% with Android users. So I think from a consumer perspective, they're doing something right, but maybe from the investor perspective, it's not enough.
That's interesting, because you go to Google and Gemini, now basically kind of anything you ask Google, you get an AI response to.
Mm-hmm.
Yeah.
Yep.
But, I think obviously the big thing yesterday was really about this kind of software, the iOS interface rebrand, this kind of liquid glass. They talked it. I think this is a year where I think the hardware upgrade, the iPhone 17 is going to be relatively modest. So, they're looking to the software to kind of really give that glitz and glamour to that kind of big announcement in September and to sustain iPhone sales as they kind of perhaps lead to more substantial hardware upgrades, maybe in 2027, which will be the 20th anniversary.
So this isn't enough then to drive more iPhone demand then, Matt, in the shorter term?
I would be surprised if it makes a real material difference to the upside. I think this is enough to kind of keep Apple. Apple customers are very loyal anyway, and this will kind of keep them in the game. So, you're kind of making incremental improvements to the product. There are tweaks with the messaging app. You can now do live translations. That's a bit of AI that's kind of creeping in. It's called quite subtle, but the look and feel of it will be quite a significant improvement, and that'll be enough for people to continue with this feeling that Apple is a high-quality product, and I'd much prefer to stay with this than get tempted to an Android device.
However, the stock comes in the year 250. We're now trading at basically 200.
Mm-hmm.
They need a catalyst.
Yeah.
Can we wait for 2027 for a catalyst?
Clearly, the market can't. It's already down 20%. So I think that there's, but it is what it is. That they're kind of rolling out against the timeline they can deliver. The Siri problems. I'm sure they'd want Siri to be much better than it is here today. Yeah. It isn't.
Is it a money? This is a company with tons of money.
No, it isn't. I think perhaps it's a fact that they were a bit slow maybe a year or two ago, maybe more than that, in terms of their AI development program, and perhaps the rest of the market has leapt ahead quicker than they thought, and perhaps there have been some internal problems about paths they went down. And obviously, because they've taken a very different approach to AI, making it very kind of privacy focused, on device rather than cloud based, I think that's created some issues for them too.
So from Apple's AI ambitions, let's talk briefly about Meta's AI ambitions. And is there some delightful irony in this story, Matt, that we have Mark Zuckerberg assembling a team of experts to achieve artificial general intelligence? So it seems we still need the humans and their brain trust to develop this stuff.
Yeah, absolutely. And this kind of connects quite well with the Scale AI investment that we talked about related to Meta yesterday. And Scale AI is all about using humans to train the artificial intelligence. So, I think this is yesterday and today, very clear statement of intent from Meta that they want to be the unequivocal leader in the kind of open source AI of the future, and that really that's the underlying platform that companies use to drive their own models. And they've got a lot of competition though against Google Gemini and ChatGPT from OpenAI. So that they feel the pressure too, and they can't really kind of rest on any laurels whatsoever. And I know that again, like a lot of the other systems, their most recent foundation model Llama 4 didn't quite live up to their own expectations or the expectations of external developers. So I think the industry has perhaps kind of hit a bit of a kind of niggle point, if you like, in terms of the kind of next evolutions of AI are not coming quite through at the pace they thought they would, and there's more smart work to be done by super smart engineers to kind of make that next step forward.
Okay, Matt, thank you very much. Matt Bloxham, Bloomberg Intelligence analyst. And plenty more technology coming to you on Bloomberg TV. Don't miss the launch of Bloomberg Tech Europe with Tom Mackenzie. That starts this Friday at 6:30 a.m. London time. Let's pivot from tech to a sector that employs a lot of it. We are talking here about banking and finance. Bloomberg has learned that Barclays is preparing to cut more than 200 jobs in its investment bank in the coming days. Part of a plan to boost the division's profitability. We're told staff in investment banking, global markets and research are likely to be affected. Let's get further details, though, and bring in Bloomberg's Tom Metcalf, who joins us on set this morning. Tom, good morning to you. So that's the sort of bare bones of it. What's the detail? How sweeping are these cuts expected to be?
Yeah, well, as you say, pretty much across this entire investment bank. So it's all part of, the strategy they've laid out in terms of we need to make the investment bank effectively more capital efficient, make the rest of the bank slightly bigger. We understand they're sort of underway. They go right up to managing director level. And just to give you a bit of sense of the scope, it's about 3% of the investment bank's entire staff. Now, obviously, every year investment banks do this, but I think there's the context of Barclays of them trying to save costs, and particularly what they're saying is, hey, we are doing this not necessarily to shrink the bank, but because we really want to focus on those areas we see a lot of growth in that we want to kind of prioritise.
The Swiss are back from Whit Monday, and UBS is down.
Yes.
UBS is beginning to feel like a different story to the rest of the banking universe because of what the Swiss government is proposing.
Yeah, absolutely. And it's really interesting to see because on Friday the shares actually rose, surprising me, based off that news. So maybe there's been a bit of time to digest it, and perhaps a sense that it wasn't sort of a particular reprieve or anything. Yeah. I think the story at UBS, as you say, is in the medium and long term, what does this mean for a big global bank in Switzerland? Because you're absolutely right, that is a jurisdiction that is going much more strict, and certainly seems like an outlier when you look at what the US, UK, and even the EU are doing.
The market's definitely woken up this morning, doing what you suggested it may do on Friday, doing it on Tuesday. The stock is down by 6.6%, as you can see in Swiss trade. Tom Metcalf, thank you very much indeed. What are we going to be doing next? The US-China trade talks. We need to be focusing on what is happening there. We've got a second day of talks taking place down in St. James's. Officials sounding, I don't know, optimistic. How high is the bar? I don't know what optimistic means in terms of a low bar. Well, anyway, we're live from Lancaster House next. We'll figure out what is happening. Talks are about to resume. This is Bloomberg.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. we're able to store energy in the form of ice as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator, a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we're giving this consumer a voice.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome back. This is the opening trade, Tuesday, the 10th of June, and we have positivity in only some markets this morning. The Stock 600 is entirely flat, but we do have a little bit of outperformance in the FTSE 100, up by 0.4% this morning. The FTSE 100 index briefly surpassed its record closing high from March, so we got excited enough about a cocktail of Rolls-Royce and energy names going higher and Diageo going higher to make that happen briefly for a moment. So that's one thing we've been watching this morning, Guy. We're also focused on some lines coming to us from the Banque de France Governor Villeroy, giving us some commentary around the ECB, saying they'll remain agile as necessary. Being in a favourable zone doesn't mean the ECB is static, he says.
What does that mean? More cuts? I'm
sure.
That kind of sounds like it could be.
The ECB has successfully normalised policy. Sounds like...
Great.
Job done.
Okay, yes. Job done, maybe, but we're going to be agile and we may do more. Yeah, that's... yes, I struggle to take much away from that in terms of what we are getting. Are we going to be able to take anything away from the trade talks that are taking place in London? We've got a second day. I think today might be the end of it, but we'll wait and see. I think the Treasury Secretary's got to go home. But the two sides are basically trying to ease tensions over shipments of technology and rare earth elements. We're not even talking about tariffs. Anyway, President Trump talking about the progress yesterday. Take a listen.
We are doing well with China. China's not easy. We want to open up China, and if we don't open up China, maybe we won't do anything, but we want to open up China. It'll be a great thing for China, a great thing for the rest of the world.
President Trump talking about the talks that are taking place in London, his assessment thus far, fairly good. What are we expecting from day two? Lizzie Burden is down in St. James, updating us on the progress. So let's talk about yesterday. What do we actually know about yesterday? Because it felt kind of one-sided. The US had things to say, the Chinese maybe less so.
Exactly, Guy. The talks went on for 6 hours here at Lancaster House yesterday. They're expected to start with a delay this morning. It was meant to be at 10. We're hearing 10:30. Maybe it's to do with those 39,000 bottles of wine and spirits in the cellar, perhaps. But look, we're waiting for the officials on both sides to arrive here. You might remember Lancaster House was the venue for that UK-EU summit just a few weeks ago. But look, the bottom line is it seems like the US is going to agree to send more chips to China in exchange for Beijing sending more rare earths to the US. But the big question is, which chips is the US going to send? And we were hearing from Kevin Hassett yesterday, the head of the White House's National Economic Council, saying that they're not going to send NVIDIA's most sophisticated H20 chips. And you'll remember, this is a long-standing bipartisan issue in Washington, that lawmakers don't want to send the US's most advanced chips. So what else is going to be on the table here? Well, it looks like they are going to be sending other chip design software, jet engine parts, chemical and nuclear materials as well, all thanks perhaps to the presence of Howard Lutnick, the Commerce Secretary, around the table, who has the authority to negotiate on export controls. It had been a source of tension for Beijing that there hadn't been someone able to negotiate on that before. But look, the point here is to walk back to where we were after the Geneva Agreement. And as you say, the sounds out of these talks so far are cautiously optimistic.
Cautiously optimistic. Lizzie Burden, thank you very much indeed. Lizzie Burden, down at Lancaster House in St James's. Elizabeth Ingleson, Assistant Professor in the Department of International History at the London School of Economics, joining us around the table this morning. Good morning.
Good morning.
Like, cautiously optimistic? What is that? Where's the bar on what we should be expecting?
I mean, the bar for a number of years now, but particularly since the new Trump administration, has been very low. Right, even a lot of the celebration of what Geneva brought in terms of sort of reducing those extremely high tariffs still left us at a place where we have 30% and 10% as a celebration. So I think that's something to really keep in mind as we sort of see what happens here in London. Is the prospects of negotiation are there, but the extent to which some of the really big sticking issues get ironed out is very, very low.
So we walk away from these talks with 30 plus 10, which I think means 40. Is that the new base case in terms of Chinese tariffs?
I think we're living in a new a world where there are base tariffs across the board. Trump isn't just in negotiations for trade deals with China. He's in negotiations with countries around the world, right? He's got a 1 month left in his own imposed. You can hear the ticking. And there's a real sense in which what's happening here with China is also part of his own desire to prove that he can reach trade deals more broadly, given he has this ticking time bomb with countries around the world as well, right? The 90-day time bomb, as he's put it. So, I mean, I think the thing to keep in mind, though, is what happened in Geneva was there was an agreement to reduce those extraordinarily high tariffs, those eye-watering numbers, down to what is simply a very painful number, right? 30%, 10%. Those numbers are still very painful. There was also an agreement to continue to talk, right? So Geneva agreed to continue those mechanisms. What wasn't ironed out in Geneva were things like China's, or at least publicly weren't ironed out, were China's export licensing practices for rare earth materials, for example. So what's been happening, particularly since then, but even before Geneva, was that China has imposed a licensing program for its rare earth material, for the exports of them. And it's been very slowly going through those exporting licensing. Part of that is a bureaucratic chokehold, but I think a very significant part of it, obviously, is the politics of it. So that capacity to hold things up via the licensing wasn't overtly agreed to in Geneva, and that is part of what is being discussed today.
I mean, this doesn't seem like the elephant in the room, which is these big tariffs that could come back in August if no big agreements are made. So, I mean, if that is all we see, some agreement around how to progress with rare earths and some US tech exports, not very fancy NVIDIA chips, but other things, does that add up to material progress, do you think, Elizabeth?
It adds up to a real... I mean, material progress, I think, is something that has become so far from how US-China relations operate nowadays that any real sense of proper strength in the relationship is very difficult to see. So it's a progress in the sense that it is a recognition that both sides are willing to negotiate. And I think that's important to recognize. They are negotiating, but as I said with Guy, the bar is so low that being seen as a progress, it really reflects how problematic US-China relations are.
There do seem to be a lot of US ambitions around these talks, and it's not sure which of these ambitions will sort of emerge triumphant. So is it about generating tariff revenue? Is is it about, as we just heard in that clip from President Trump, opening up China? I mean, that sounds like more trade, not less, but just in a different direction. It really is maybe just about rebalancing that trading relationship. I mean, do you have any sense of where the end goal is?
I think with Trump, the capacity to balance the relationship with China is so much more complex than, and will not be solved by tariffs, that his way of getting there is, and the process that's happening now is not going to get there. I think what's really important for Trump is to prove that he's able to reach some kind of deal. There's a reason he is so focused on the bluster of this, and that Geneva, again, was so touted as such a success, is that Trump needs to continue that narrative that he knows how to make a deal, the art of the deal. So there's a lot at stake for Trump narratively. And as I say, that's got even more to do with his larger sort of trade wars with the rest of the world as much as it has to do with China. In terms of US-China dynamics, that's and the sort of trade balance, imbalance between the two, that's a very structural, long-term problem that no set of tariffs and no set of negotiations are going to solve overnight. I will also say that trade deals, whether it be with the United Kingdom, whether it be with China or elsewhere, they take years to negotiate. Yeah. So Trump's ticking time bomb of, 90 days up with the rest of the world next month, with China in August, I mean, even that is not going to reach anything of true substance. It might indicate a capacity to move forward and a blueprint for doing so. But these deals take years.
I do sometimes wonder if I'm a victim of, and we are all a victim of, a sleight of hand in all of this, in as much as, he wants to be seen as being the sort of deal maker, and we're focusing on the trade talks. But what's happening at the same time is the dollar's depreciating. Yeah. Like, significant. We had a conversation around the table a little earlier talking about kind of 140 on euro dollar. Yeah. That changes trade beyond all recognition, and way more than any kind of trade deal is going to change. And we're now talking about capital wars as well. We're talking about money not flowing into the United States in the way that it has done for 15 odd years. Is there some sort of, am I missing something by looking over here? And what I should be really focusing on is, as the dollar just continues to depreciate, trade patterns will change dramatically.
No, Guy, I think you've hit the nail on the head. I think one of the really important things that's going on right now is that we, as a global society, are living through extraordinary structural change. We are, and you're right to be pointing to the depreciation of the dollar, pointing to the norm now of tariffs, right? We live in a tariff world. I mean, these tariffs that are currently imposed on US-China, for example, are around the same level as what the first trade war with China was in the first Trump administration, which was, at the time, conveyed as this real moment of crisis in the global economy. We're now normalizing that. That is now being celebrated, right, post Geneva. And so I think there are some really significant structural changes happening in the global economy to do with normalizing tariffs, to do with the role of the dollar, to do also with the way in which energy is even produced, right? So I've spoken before here about the way in which China has really significantly shifted its energy production and moved now to a space where its green energy production is a significant driver of GDP, it's a significant driver of growth, and it's also a significant source of its energy. So we are living, I think, more broadly in a global shift, a rupture, if you will.
If we're seeing that big global shift, that big rupture, what role does China see itself playing in the global economy with that in mind?
So more and more it is asserting itself. We're seeing it on sort of bilateral spaces, so, China celebrating a mega port in Peru, for example, and so really celebrating that to the point that Xi Jinping himself attends the opening of this mega port. So we're seeing it infrastructurally on a bilateral level across the global south, in America's back door. We're seeing China really start to sort of therefore shift the way it trades, the way it interacts with the global economy, shifting away from the United States. But we're also seeing a real assertion assertion of international leadership as well, an attempt at creating, again, a narrative of Chinese power, Chinese leadership in the world.
And will it become more of a consumer economy? I mean, that's one of the things that the US would like to see. I think Scott Bessent's spoken about that, about encouraging Chinese consumers to consume the things that China makes.
Yeah.
Is that going to be part of the conversation for China?
I mean, it is already a really significant part of the conversation in China, is the role of consumption in the Chinese economy is really problematic, in fact. Like, so I speak of some of the structural changes happening in the Chinese economy, but it's also facing extraordinary limitations, and one of them is a real lack of consumption. Partly that has to do with a real crisis in the housing market in China. So the middle class in particular have a real constraint as the housing crisis has evolved. So their spending, their desire to spend has been is limited by these like larger problems. But I think there's also a real question to be asked about the sustainability of an export-oriented model, and that is what Xi Jinping has been shifting away from for a number of years. We see that now with Made in China 2025 being revamped, so holding on to this vision of having a self-sustaining Chinese economy, but one in the new revamping that Xi has put forward, where they continue and have doubled down on a desire to have a more higher manufacturing space economy.
Yep. Okay, Elizabeth, thanks so much. Thanks for joining us. Elizabeth Ingleson, Assistant Professor at the London School of Economics, helping to set the conversations taking place here in London around China-US trade in some bigger picture context for us. Also going on in US politics, Los Angeles sees continued unrest, and DC politics is at the centre of that, of course. Immigration policy very much in focus. We'll bring you the latest on that. This is Bloomberg.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter. But it's bad for the product. It's not good. After that, I'm never doing that again.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bring you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
"47 minutes into the equity market session, you are looking at a fairly unchanged picture, but actually within that, some interesting things happening. We'll talk about defence in just a moment and what is happening with the UK house building sector. Let's talk now about what is happening out in California. The Trump administration has escalated its response to anti-deportation protests in LA by mobilising some 700 Marines now and another 2,000 National Guard troops. The move comes as California is suing the administration for deploying the military in the city without the governor's permission, basically. The US president backed comments suggesting that Governor Gavin Newsom should be arrested. The governor pushed back, saying, "Come on, bring it on." That seems to have been the response thus far. Charlie Wells is here with an update. Rhetoric versus reality. Break it down for me.
Look, a lot of heated language here, I think, coming from both sides. But what's really important to focus on here is, look, California is the world's 4th largest economy when you measure by GDP. LA is the largest city in that economy. So whenever there is disruption here, it's important to focus here. And I think one of the key points here is this deployment of active duty military personnel. Now, in the United States, that is incredibly rare. That is supposed to be used in very specific circumstances. And I think this is what a lot of politicians on both the left and the right are concerned about. And I think the other point here, too, I think just, you know, for people who maybe aren't super aware of LA, it's an enormous city, right? By some measures, 10 times geographically larger than London. And so you see these protests, there has been violence in a number of areas, but they are limited to, you know, a small section of the city, at least so far.
Yeah, so far. I did sort of expanding into other areas, but again, in small pockets. What are the key issues then in California's lawsuit against the Trump administration? Because this is the pushback by Governor Newsom is going to come in the courts, it would seem.
That's right, Anna. So just a few hours ago, California asked a federal judge to block this deployment of these National Guard troops. And basically, this gets at one of the kind of unique features of the National Guard. It's a unique branch of the United States military, which it has state competencies, but also federal competencies. And usually the National Guard is under the control of the state. Again, this is Newsom in California saying basically the circumstances where the federal government can come in and deploy these troops is not being met. There's just not evidence that, you know, there's a rebellion or an invasion. That's usually the case where the federal government could step in. And just looking at the history here, the federal government has not deployed the National Guard without the consent of a state government since 1965. That was during the Civil Rights era. They last really deployed with the kind of blessing of a California governor in 1992 during those LA riots. So this is incredibly rare, and it kind of gets us this kind of federal versus state level issue in the United States.
So where next? What are we doing next? What are we watching for?
A lot of this depends, right? Is there an escalation? I think politicians have talked about, you know, does the deployment of these active duty military personnel, does that ratchet up the tensions between the military and between protesters? Anna got at this point of, you know, these protests moving beyond just Los Angeles, of course. And I think one of the issues that we saw during the Trump campaign was him talking about deploying the military more broadly. He also talked about immigration. I think if you put those two together, this could ratchet up. But at least so far, we're not seeing that, at least not yet.
Charlie, thank you. Bloomberg's Charlie Wells, of course, with the latest on what we are witnessing in Los Angeles and increasingly further besides, but confined to specific pockets, as Charlie says. Let's take this to a markets angle, shall we? Bloomberg's Valerie Teitel is back with us. And Guy and I were throwing this around at the start of the programme, Valerie, about this is all, we'll leave the sort of the politics around immigration perhaps to one side, but there's economics around immigration, which was an important factor when lots of jobs were being created under the Biden administration, and now we're seeing something different.
Exactly. I mean, I think, you know, the markets maybe look at what's going on in LA as a reflection of this tight immigration policy, which in the market's mind will have, or maybe is already having an impact on labor market dynamics in the U.S. We had that strong payroll report last Friday. You know, the unemployment rate is staying steady. Maybe a lot of that is being driven by the fact that those border crossings since Trump took office have really plummeted, and these deportations taking people out of the labor market that eventually, you know, essentially is inflationary in some way if you view it as that. It keeps labor costs high for corporates. It eats into margins. That's something that could be inflationary. Not that I'm thinking it's going there. I think the first round effect is just a tighter labor market than expected.
We could end up in a situation where actually payrolls come down quite sharply. The headline number comes down quite sharply, but actually the unemployment rate stays fairly static.
The household survey, yeah, definitely. I mean, those kind of things have happened in the past. They don't normally. It's normally just a month or two where those two de-link. They normally do converge at some point, but you could definitely see maybe a more sticky unemployment rate versus payrolls maybe showing some softness. That could be something that could be a net of this, but. I mean, if you think about this very broadly, the Fed won't be able to cut in the face of this tariff-induced inflation worries unless we see a rise in unemployment. And I think that's what this immigration being really brought to the forefront, that's how it's really affecting at least monetary policy.
Right, and then we get to the other part of their dual mandate. Take us to how the market is going to be dealing with trade headlines today, Valerie, because we've got day two of the conversation between the US and China, and we were talking to Mark Cudmore from the Markets Live blog earlier on, who was saying actually markets are quite level-headed in terms of their expectations here. We're just talking about rare earths and chip exports, and that seems to be the focus. And US futures perhaps taking a bit of a leg down on our sort of range-bound expectations for these talks.
Yeah, it's definitely hard to tell, hard to get a sense, but I have heard the same things as Mark Cudmore, that expectations for a result coming out of these talks in London is quite low, which you could maybe read that in a bullish scenario, that as long as it doesn't totally fall apart and not a disaster, that the U.S. equity market will be able to hold together. But if we take this to FX, the U.S. dollar has tended to rise on days where there is trade optimism, and that's something I think has been very unique to the U.S. dollar since this trade war began. I don't think people thought that kind of dynamic would eventually be one to play out, but if we do see maybe an unexpected result coming out of this, I'd definitely be looking at how the U.S. dollar reacts because we are still hovering around year-to-date lows, around multi-year lows in the Bloomberg Dollar Spot Index, and maybe this could be the next catalyst to break higher.
Also, what I've also heard this morning is that there's an expectation increasingly that 40% tariffs are the new normal. And I wonder whether that's what the market has got its head around as well. Are we expecting to go back to much lower tariffs? Elizabeth Ingleton was here just a moment ago saying, structurally something's changed. We are in a higher tariff world. And I wonder whether that is represented in kind of where pricing is right now.
Well, at least I don't think there's the expectation that we get back to this, 100-plus tariff escalation. So, whether they stabilize here or come down, I think
it's 40%. It's 40% good news. So this is the sleight of hand that I'm worried about at the moment. That we've come from a position where 145 was really bad, but 40 sounds quite good.
So 145 is definitely a trade embargo. 30 or 40% is unclear. I mean, we can even point to the trade export data yesterday, the China export data to the U.S. They dropped by 35% in the month of May. That's not an embargo, and they were dealing with quite high numbers for most of the month of May. I think the 135 tariffs are over 100 for most of May before they were rescinded. So in some ways, maybe that gives them a bit more time. Maybe gives China a bit more time to do these trade talks because they're definitely in a deflationary spiral. And the pileup of these goods that were expected to go to the U.S., those piling up in China is definitely not something they want. And that's something probably Europe is worried about, too. Those cheap goods being dumped elsewhere in the world, causing deflation pressures elsewhere.
Valerie, thank you very much indeed. Very so. Walking us through the markets throughout the morning. Let's talk about one other aspect of the market that we should probably be paying attention to this morning, and that is what is happening with defence stocks. There's a Bank of America note out this morning that seems to be causing some consternation. As you can see, you are seeing some fairly significant drops. Saab is down quite hard, Rank's down quite hard. What is interesting is actually they're quite positive on BAE, which is kind of holding ground this morning. So a much more nuanced picture rather than simply just buy defence.
Right, yes, that takes us to the UK side of things, where we are seeing some UK house builders doing pretty well, and that could be on the back of the Bellway numbers. We've got an update from one of the house builders there, but also the fact that yields are coming down in the UK. If you look across the UK curve, we're down by 7 basis points at the 2-year, with a similar level at the 10-year, and that stands out on the back of the weakness in some of the data we've had out in the labour market.
Funding, so what happens with government deficits, what happens with governments tomorrow, I think could be quite interesting. Obviously, we've seen the market freaking out in the past about kind of just how much issuance is coming. All of that could be a feature for the gilt market tomorrow. Francine Lacroix is going to be sitting down with Elie Maalouf a little bit later. He is, of course, the CEO of IHG. That's a conversation we're looking forward to. Hope you enjoyed the show. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
The Trump administration sends hundreds of Marines to Los Angeles in response to protests. California's governor, Gavin Newsom, calls the move reckless. Trump suggests Newsom should be arrested. U.S.-China trade talks resume here in London, with officials sounding optimistic on the outcome. Plus, Apple introduces a number of new features during the company's annual developers conference, but it fails to ease concerns over the tech giant's AI offering. Now, also coming up, we'll be joined by top business leaders. We'll have interviews with the chief executives of IHG Hotels and Resorts, as well as Accenture chief executive. Now, first things first, let's just quickly check on the markets. Again, there is a little bit of anxiousness out there because of the unrest that we're seeing in the U.S. We'll have a terrific roundup trying to understand what happens next, if it's de-escalation. And then a couple of the other things that we're watching out for is also UK stocks actually hitting a record on some of what we've seen overall, the talks, of course, between the U.S. and China. So look out for that. The U.S. 10-year yield, 4.4520. You can see sterling at 134.76. Now, let's also take a look at the European markets map. Again, this usually moves on the back of what we're seeing from Asia. The CAC 40, but also the MIB in Italy and the FTSE gaining between 0.3% and 0.5%, and the DAX actually lower. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the Trump administration has escalated its response to anti-deportation protests in Los Angeles by mobilizing some 700 Marines and another 2,000 National Guard troops. Now, the move comes as California is suing the administration for deploying the military in the city. The U.S. president backed comments suggesting that Governor Gavin Newsom should be arrested. Well, we're now joined by Rosalind Matheson, RMA News Director. Ros, there's a lot happening. This feels extremely big also for the consequences longer term. Like, give us a sense of how you're viewing this and actually what we saw overnight.
Well, that's right. So overnight what we saw were peaceful protests, morph a little bit into some violence again overnight, but contained to a pretty small area of Los Angeles. We are seeing protests also in San Francisco and a number of other cities in the US, but fairly small in size. But again, this is contained to a pretty small area of LA, and that's the argument, obviously, that officials in California are using, is saying we've got this under control and we can bring it under control. And now we have the news that on top of the US federally assuming control of the National Guard, there is deploying active duty Marines to US soil. And that's very, very unusual to have active service people operating in the US in a domestic basis. So again, what kind of precedent does that potentially send? So there's all questions around the legality of this. Obviously, there's a legal challenge that's coming. There's the question of federal power versus state power. And there's also the kind of personal aspect to this, in a way, which is the tensions between Donald Trump and Gavin Newsom, which have been there for many, many months, bubbling up periodically. But obviously, you know, one thing in the back of minds here is that Gavin Newsom may easily be a contender for president in the next election. And so is there politics playing into this also?
Yeah, so Rosa, it's very difficult to either say this is another, Donald Trump fighting with someone, a bit like we saw with Elon Musk, and this time he takes aim at Gavin Newsom, or whether this is in preparation of something bigger. And there's media articles saying, like, look, he's testing the institutions, the president's testing the institutions in case he needs to deploy this in other, situations. That'd be very sinister. Like, how do we know?
Well, that's right. You can see a pattern of behaviour from the Trump administration challenging institutions, be them universities, the courts, some of the federal agencies even, and the powers, again, of the states. And we've seen, Donald Trump talking about let's deploy National Guards here and here across America, and that can be for a variety of reasons. It can be to safeguard the border. Obviously, he's talked about that with migration, but also now it seems increasingly for domestic purposes. And so if you're controlling the National Guard, the military, and you're pushing them more into the domestic sphere, I mean, that's something that becomes very delicate very quickly and can have long-running ramifications. And again, it's the pattern of pushing these institutions, a lot of legal pushback, but the US administration moving very, very quickly to try and enact what they want. And where this goes is a very open question. But obviously, once you're talking about troops operating in on US soil in this fashion, it can be quite dangerous.
Rose, thank you so much. Rosalind Matheson there, our EMEA News Director, now joining us to talk about the markets, maybe some of the consequences of some of the things that we're seeing in the U.S. Maya Bandari, EMEA Multi-Asset Chief Investment Officer at Neuberger Berman. Maya, as always, thank you for being with us. Look, I know we want to talk about fiscal policy. I know we want to talk about Fed. When you see some of the turmoil that we're seeing on U.S. soil, how do you think it'll play out on the markets?
Well, Francine, I think, geopolitical risk, and this is part of that sort of broader geopolitical risk, is something that is gonna sort of whipsaw markets as we go along. But I think certainly up front and central for markets has been, trade wars and where those end. Fiscal policy, this transition, as you just mentioned, from monetary to fiscal, Section 899, how does all of this fit? How do we think about all of that? Labour markets and monetary policy, something that we talked about on the previous set. And so I'd say there are 3 or 4 big factors that markets are grappling with, and this is one of them.
Which I love. I mean, you call them the 4 horsemen of asset allocation. I mean, do they work at the same time, or could they be, muddling the situation if one does one thing and the other one goes against it?
Yeah, I mean, I think, we call it the 4 horsemen of asset allocation, really, to frame it as the 4 key strategic risks. And look, I mean, I think they come and go at different times, but I think they're all the big message from us at Neuberger Berman is that these 4 strategic risks are sort of here to stay on the forecast horizon and will impact markets on a 6 to 18 month view.
Maya, so trade talks, you mentioned trade talks between the U.S. and China continue into a second day in London as the two sides look to ease tensions over shipments of technology and rare earth elements. Our Lizzie Burden has been tracking the negotiations and joins us now outside Lancaster House where the talks are taking place. So, Lizzie, what progress has been made and what's actually expected today?
Well, Francine, the talks went on for 6 hours yesterday here at Lancaster House, and you might remember it because it was the location of that UK-EU summit just a few weeks ago. Now, we're hearing that the talks this morning have been delayed from 10 to 10:30 a.m. Maybe it's got something to do with those 39,000 bottles of wine and spirits in the cellar. But when they do continue, we're expecting the bottom line to basically be that the US is going to send more chips to China, and China is going to send more rare earths to the US. We're expecting more of this progress on export controls, partly because of who's in attendance here. Alongside the US Treasury Secretary, Scott Bessent, and alongside the US Trade Representative, Jameson Greer, you've also got the Commerce Secretary, Howard Lutnick. And it had long been a source of frustration for Beijing that there wasn't someone around the negotiating table who had the authority to deal on export controls. But they can do that now. The question is, which chips are going to be going from the US to China? And according to Kevin Hassett, the head of the White House's National Economic Council, it's not going to include the most sophisticated chips, NVIDIA's H20 chips. And of course, it's long been an issue in Washington, a bipartisan issue, that the US doesn't want to send its most sophisticated chips to China. So the other export controls that should be lifted, we expect, will be on chip design software, jet engine parts, and chemical and nuclear materials as well. So overall, the theme seems to be that they're heading back towards the sense of a better relationship between the US and China that they reached back in Geneva.
Lizzie, thanks so much. Lizzie Burden there with the very latest, of course, on these US-China talks in London. Maya, it does seem like we're taking a step forward, 2 steps backwards. Unclear if these talks hold, if they find an agreement that holds for longer than 6 months. What do you think is priced in the markets?
Well, I think markets have really struggled to price in very much at all. I mean, you look at equity markets, for example, and they look pretty sanguine. Bonds less so, and we can come on to that. But I'd say from sort of maybe 3 high-level observations on the trade and tariff discussions. Number one, with what we know, and I think that's a sort of 30% effective rate on China, tariff rates charged by the US on the rest of the world are back to the 1930s. So it is a significant shift from where we've been, point number one. I think second, that the uncertainty, to your point, around where we land, what the retaliation may be, is significant, and I think ultimately may matter more for companies and therefore markets as we progress. And third, tariff wars and trade wars represent a supply shock for the US and a demand shock for the rest of the world, and that really has a lot of bearing on how their respective policymakers are able to respond to this.
So what does it mean for how you deploy capital, actually? Have companies started to have seen like changing routes that goes between the US and China? Does it mean more like third parties in Asia, or is still a lot to play?
I think there's still a lot to play. I mean, we're seeing and hearing early signs of some of the disruption, for example, in some of the responses to the ISM last week. But I'd say, how we're approaching it, certainly from an asset allocation perspective at Neuberger Berman, is we've allocated away from US assets towards non-US assets, and that's in equities, bonds, and importantly in FX. We're long of gold, key way to sort of try and protect client portfolios from, the 4 horsemen as we discussed, and really taking light risk, Francine, in terms of our overall asset allocation, because there is an awful lot of uncertainty here, notwithstanding what you might take away from, the high level of how equities and risk assets are behaving.
Maya, what are you expecting the Fed to do in this environment?
Well, I think the Fed's in a tricky spot. I mean, I think we certainly don't expect the Fed to respond with sort of the 100 basis points of rate cuts that were requested, if that's the right word, by the U.S. president last week. Look, I mean, data on the one side, data is weakening. The labor market in particular is weakening, but we don't think it's weakening to a degree whereby the Fed is going to rush in to move rates, and that's because, to our conversation a moment ago, tariffs do pose an upside risk to U.S. inflation, and they're going to want to wait and see how this all plays out. There's a lot to play for, as you put it, in terms of where we land on this. It's in a tricky spot.
It is in a tricky spot. I mean, also, some of the inflation expectations actually declined across all horizons, according to the New York Fed.
Yeah.
So it's not really behaving the way that a lot of people thought it would.
Yeah, I mean, and the New York Fed, I think, was a bit of a relief for markets yesterday because, of course, the other big survey that we've all been watching is the UMIR survey, where 1 year ahead inflation expectations are now at 6.6%. So it was a relief to see these numbers coming down and with a much lower handle. We'll, of course, see more this week with the U.S. inflation numbers. But again, it's too soon, in our view, to see some of these tariff impacts coming through. I think we'll see that at the back end of Q3 and early in Q4 once we actually know where we're going to land.
Maya, what do you do with Europe in this environment?
Well, Europe's an asset that an area that we've liked in equities, fixed income, and in FX. So we've been long of Europe in a few areas. And look, I think Europe's got a fairly supportive background. If we look at the equity market, for example, it's done quite nicely this year, but only half of that increase has come from valuations. The other half has come from earnings. And when we think about the scope for earnings to rise in Europe, given the fiscal backdrop, the monetary backdrop, the growth backdrop. 200 basis points of rate cuts from the ECB are feeding their way through the European economy. We're seeing the numbers improve, and we think there's a broadly supportive setup for Europe here. Currency, similarly, and we'd look for further moves in the euro-dollar, for instance, something we're actively expressing not only in asset allocation portfolios but also our FX portfolios.
And Maya, do you make a big difference between the UK and I guess the rest of Europe? UK stocks hitting a new record.
Yeah.
I think the FTSE 100 is actually close to an all-time record for the first time since March.
Yeah, I mean, I'd say the FTSE 100 in particular is a very different animal, if that's the right word, to the European markets. 75% of the revenues come from overseas, so it's very much an overseas play. But indeed, UK equities have done quite smartly, as have European equities, but I'd say for quite different reasons. And it's really been Europe and indeed areas of Japan, like Japanese banks, where we've been deploying our risk.
Okay, so interesting. Maya, thank you so much. Maya Bandari there, EMEA Multi-Asset Chief Investment Officer at Neuberger Berman. Coming up, our exclusive conversation with the Chief Executive of IHG Hotels and Resorts. We'll discuss the impact of President Trump's policies on the travel sector, but also much more. That's next, and this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Tech is integrated into every aspect of our lives, from finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Tom McKenzie in London. Watch the new Bloomberg Tech Europe. Premieres June 13th, only on Bloomberg Television.
Now, President Trump's policies are upending travel worldwide. The trade war, the crackdown on the border, and ban on visitors from a dozen countries have led to tens of thousands of canceled trips. Now, with travelers choosing alternative destinations, the U.S. economy is expected to lose out on about $12.5 billion this year. Well, to discuss the outlook for the sector, I'm delighted to be joined exclusively by Elie Maalouf. He's Chief Executive Officer of IHG Hotels and Resorts, one of the world's largest hotel companies with a network of over 6,000 hotels in more than 100 countries and many, many brands that go with it. Elie, thank you so much for joining us.
Hi, Francine. Good to be with you.
Elie, talk to me about travel. So everybody, I mean, our viewers love talking about travel. They want to know where the hot destinations are. You know, analysts pour over it to understand also barometer of the economy. How's 2025 looking?
You know, if you look at how we started the year, we reported our first quarter. Our RevPAR grew 3.3% globally, 3.5% in the U.S. Look, we recognize that there was a lot of turbulence starting in February, then in March, but we see things settling down, right? You know, trade tensions have turned into trade talks. You've got some deals coming up. There's renewed optimism. The financial markets have recovered. And despite all the concern about travel, UN Tourism reported last week that international travel to all countries grew 5% year over year. The World Travel and Tourism Council said last year was a record for travel. This year they're expecting another record. And so, travel seems to push through a lot of the geopolitical concerns.
So, Elie, what's it looking like in the U.S.? Are people canceling trips and going elsewhere because, you know, they watch the news, they're a little bit nervous about what's happening? And is there a particular region that's more reticent to go to the U.S.?
You know, we saw some of that in the beginning of the year. We saw reduction of travel from Canada, and in March, you saw some reduction of travel from Europe. Part of that, actually, from Europe was really related to Easter moving from March to April, so people didn't have their holidays in March.
The calendar.
Always the calendar. So we're not sure how much of it was calendar, how much of it was concerns. However, April, we saw a bounce back of travel from Europe to the U.S., so maybe that was Easter again, and it's hard to tell. Overall, though, let's put a couple things in perspective. 95% of our business in the United States is domestic U.S. travel. Right. Only 5% is international, 1% is Canada, a couple percent is Europe. And so, you know, you look at Memorial Day, it was record travel in the U.S., 45 million travelers. The expectation for the summer is people are going to travel more, not just for leisure, but also for business. So I think the year started off with a few bumps, but it seems to be settling down.
I mean, I'm looking at some of the revenue per room. It's still rising in the U.S., but slower than other markets. What's that a reflection of?
Well, part of it's a reflection of large numbers. The U.S. is the largest travel market in the world, so it's the biggest denominator. So really growing at 2 to 3% is still a lot on a very big base. And then as you move east of Europe, Middle East, Southeast Asia, India, China, populations are younger, GDP is growing faster from a smaller base, but growing more quickly. And those are the two vectors that grow travel around the world. Growth of the middle class, growth of GDP, that's a secular, you know, uninterrupted trend that powers travel. So it isn't as if those markets are stronger. They're just growing from a smaller base, but they have younger populations and stronger GDP growth. We have to recognize that over time, while the U.S. and Europe are going to be the dominant markets for travel for a long time, growth is moving east.
East, but actually China's in decline. So how do you deal with China? Is it, you know, east but outside China that's doing better?
I think it's really both. Yes, India, Southeast Asia are growing more rapidly from younger populations, faster GDP growth. But let's not forget, China's a $20 trillion economy, still growing at 4 to 5%. I mean, there is no other economy beyond the U.S. or China that's in the 20-plus trillion. Everything else gets below 10 trillion. Second, the population may not be growing anymore, but the middle class is growing. It's projected to double in the next 10 years by another 150 million people. By the way, 150 million people is about the same as the middle class in the U.S. So you have a whole new middle class coming. And so that growth of our industry in China will continue for generations.
So for China, what's your strategy to maintain market share, to grow? Have you, for example, had to change your pricing?
Not really. We've been in China 50 years, Francine. I was there in January, had a great time. We celebrated our 800th hotel, our 50th year. We're going to be nearly 1,000 hotels in 18 to 24 months with another 600 under development. We see ups and downs in China over 50 years, but it always makes higher highs and higher lows. Let's not forget, doubling of the middle class, technology, innovation, productivity. And then the really other thing about China is it's the second or third largest outbound market from the world. We're growing in Asia-Pac, in Japan, Singapore, Thailand, Vietnam, because of the outbound Chinese traveler. 80 to 90 million people a year travel outside of China.
Is there anything that worries you about China? Because you seem pretty optimistic. The year started not too great, but now it's looking up.
I mean, clearly, there are concerns about the overbuilding of the residential real estate market. That has been going on for 3 to 4 years. They're digesting it. It took the United States 5 to 6 years to digest the overbuilding of real estate from the GFC, right? From 08, 09, it took till about, 2012, 2013, 14. So they're digesting that. The trade tensions are probably bearing down on people a little bit, but we also saw that, we're moved from trade tensions to trade talks right here in London.
I know,
as we said right now.
So does it change actually the way people travel? So is it not that actually people still travel but spend a bit less if there's trade tension or if people feel uneasy, or do they actually cancel travel?
So what we're seeing, it's a great question. What we saw in China all year last year, and even in the first quarter, was the travel volume was the same, actually higher, but domestic rates were a bit lower. However, the higher rated Chinese traveler went to Asia-Pac, went to Japan, to Tokyo. They love Tokyo, Osaka, Kyoto. I mean, it's just record travel from Chinese travelers to Vietnam, to Thailand, to Singapore, to South Korea, Indonesia, Cambodia. So the higher rated traveler went to those Asia-Pac countries. We were up double digit in that region all last year, first quarter of this year. So it did change the pattern a little bit.
Talk to me a little bit about the UK. Is it difficult to find people, actually to find workers, given some of the rules?
It got difficult after Brexit, 6, 7 years ago. I think we worked our way through it. UK is an incredible destination. People from around the world always love to come here. We honestly wish we had more hotels in the UK.
Do you worry? I mean, again, there's been ICE raids in the US. Does that make it more difficult to find staff? Does it mean, this is very practical solutions that you need people to staff the kitchens and, of course, help in the hotels.
We're clearly monitoring that. It's been mostly isolated. It hasn't really affected our business at scale. I mean, keep in mind, we're over 4,200 hotels in the United States with hundreds under development. We're spread, in all 50 states, in most of the counties. So we're not concentrated in urban areas. Our business is much more distributed across the country. And we believe that, these have been isolated incidents, but we're monitoring them very closely.
I know you have some really historic hotels,
Yes.
around the place.
Sure.
Do you have a favorite? Is there one that, because of the history, because of what it represents, maybe even record travelers today?
You're right. I mean, we have some heritage buildings around around our business that have been with us 80 years. I'll never name a favorite because they're all like our children, and I love them all. I love all of our brands, all of our hotels. I wish they get to see more of them. But, we're now 6,700 hotels around the world, Francine, with another 2,300 under development. 1 million people stay at IHG around the world every night of the year, 1 million people. But put it in perspective, we're still only 4% of the room supply in the world, so we have decades of growth ahead of us.
What surprised you the most in the way people travel? I imagine over the last 5-10 years, people used to stay in a hotel and then go explore the city. Now maybe people go check in a hotel and want to stay in the hotel, more experience. Have you had to do parts where there's social media so that people can use it, and it's also advertising?
Yeah, we do that. I think there are two trends that we watch very closely that have changed over the last, say, decade. Number two is really the blending of work and leisure, right? Workations. Right. And people are staying actually longer. They're, instead of checking in on Friday, leaving on Sunday, they're checking in on Thursday and leaving on Tuesday. And they're blending that work and leisure. I think that's good for our business, but we have to make sure they have the productivity in the hotels so they can enjoy themselves, but also be productive. The second thing is really the silver economy. The people that are slowing down and retiring in North America, in Europe, in Asia, China, and Japan, the huge transfer of wealth. But, as they slow down, the one thing that they want to do in their lives is travel. And they can travel all year, right? They don't have to wait. Yeah. Their motto is, go first class, or your children will.
I quite like that, Ali. Thank you so much. Ali Malouf there, Chief Executive of IAG Hotels and Resorts. I'll remember that. Coming up, we'll discuss how companies are navigating economic uncertainty and geopolitical landscape with the Chief Executive of Accenture.
In case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. I'm not saying it's going to happen. I don't want the reader to say he's predicting. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. You know, with all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last? And the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. The Trump administration sends hundreds of Marines to Los Angeles in response to protests, while California's Governor Gavin Newsom calls the move reckless. Trump suggests Newsom should be arrested. U.S.-China trade talks resume here in London, with officials sounding optimistic on the outcome. Plus, Apple introduces a number of new features during the company's annual developers conference, but it fails to ease concerns over the tech giant's AI offering. Now, the Trump administration's mobilization of active duty military in California's anti-deportation protest is raising key legal issues with national ramifications for the U.S. Well, Charlie Wells is here to talk us through these developments. So, Charlie, California suing the Trump administration. What's actually at stake in the lawsuit?
Well, Francine, the case is called Newsom v. Trump, and in it, the state of California asks a federal court to halt the deployment of the state's National Guard troops and the Marines in these anti-deportation protests that we have seen over the past few days. And what this case really gets at is when the President of the United States can deploy the military for domestic law enforcement purposes. Now, history and the law shows that this should be used very rarely, at least according to a number of pieces of legislation really getting at the point that when the president can deploy military is in cases of existential threat, of issues such as insurrection or rebellion. Now, California in this lawsuit argues that there just is not evidence that the state was unable to maintain order, and they also say that this deployment is a violation of the U.S. Constitution, of the 10th Amendment in particular, which limits the powers of the federal government.
Charlie, where does it look like the conflict between California and the Trump administration actually goes from here?
Well, Francine, on the campaign trail, Donald Trump talked a lot about two issues, immigration and the broader use of the military. And this really is a combination of those two issues. So there is a world where we see a ratcheting up of those in conjunction. There is also a concern from a number of legal scholars that even if cases such as the one that California filed are not ultimately successful, the deployment of military in the United States against protesters could send a chilling effect. This idea that if you are making some sort of protest that the president doesn't agree with, you could see the military deployed against you. So those are significant threats. We have not seen as much of a ratcheting up of this conflict as many had been concerned about, but we're still monitoring the situation.
Charlie, thank you so much. Charlie Wells there with the very latest from the U.S. Now, our next guest took over as chief executive of Accenture in 2019. The consulting and technology giant has been grappling with a pullback in customer spending, but also greater scrutiny of U.S. government contracts under President Trump. Now, beyond Accenture, her influence extends to critical boards like the World Economic Forum, Center for Strategic and International Studies. Julie Sweet, the chief executive of Accenture, joins us now. Julie, thank you so much for joining us. It's wonderful to speak to you, actually, since February and since your news. When you look at the U.S., there's a lot of news coming out of the U.S. It could be the protests. It could be what the Trump administration wants to do on DEI. In general, what's business like in the U.S.? Or are people in a bit of a wait-and-see situation, or do they ask you for more advice?
Francine, first of all, thanks for having me. It's great to be back here in London. And actually, I think the idea of wait and see and pause is really yesterday's news. I'm talking to CEOs virtually every day, and there's two words that they're using: focus and leapfrog. And so for CEOs today, they're trying to find ways in this uncertainty to say, how can I actually leapfrog, whether it's leapfrog with technology, leapfrog, with the new products. And focus is a big word because they know to focus that you need to accelerate. And our best advice to CEOs right now is that if you're not operating differently than you were a year ago, you may be falling behind.
Differently in terms of what use of AI, in terms of supply chains or trade, or is it just mentally how you look at risks?
Really three dimensions. One is at speed. So, many companies talk about they're too slow, they're too complex, they operate in silos. And this environment we've seen very clearly, for example, with the tariffs, where things are having to turn on a dime as you think about supply chains, is that speed matters. And speed isn't just about working harder, it's about really changing the way they work. AI is certainly a big component because of the opportunities that are very important to this. And then third, it really is about mindset as well, right? Is this idea of, yes, we need to build resilience, but we need to also build growth despite the environment. And that requires a different strategy than just a year ago.
But do you see actually chief executives pulling back investments or not investing as much or even not doing M&A because of the environment? Because you're not really, you don't know what you're looking into like 3, 6, 8 months from now.
Well, it really varies on the industries. So, for example, in telecom, right, they're not nearly as affected by the tariff situation. But also, one of the things that I'm telling all CEOs, particularly around investment in technology, is that because we work across 19 industries, in every industry, we are seeing people actually increase investment because they want to leapfrog, because they want to win in this environment. And there's no one who is able to just sit on the sidelines because they think their industry may be a little bit slower and they can wait and see. And that's different than prior tech, trends.
What are financial services companies telling you? I know you're a massive employer within financial services. Are you hearing from bank CEOs that they're uncertain about the future, or actually have they figured out how to navigate this uncertain, ever more uncertain environment under the Trump administration?
Well, it's a great question here in London. We just opened our UK Innovation Centre focused on financial services because this is obviously such an important industry here. So we're hearing every day about the innovation. And, you know, while, of course, we hear lots about what they view on the environment, what I would say in the industry, banking and insurance are both very much looking to invest to harness the power of AI. And so we're seeing it, for example, in fraud. We're seeing it in improving growth in insurance because you can now use Gen AI to read so many more submissions from brokers and manage your risk better. So very concrete examples at scale. And, you know, financial services is going to lead the way in using some of the power of AI, not just for productivity, but actually really focused on growth.
How do you use AI actually internally? Is it through, you know, staffing? Is it changing the work of a lot of your people, and so do you need retraining?
So we are upskilling our people across the board. Just to give you some idea of the reinvention of Accenture around AI, when Gen AI hit in November of 2022, we had about 30 people working on Gen AI in our innovation labs and with clients. Today, we have over 500,000 people who've had the fundamentals of Gen AI, including 2/3 of our employees here in the UK. And, you know, we went from 300 million of sales in the first 6 months after ChatGPT was introduced to 2.6 billion in the last 6 months. When you think about the scale of that transformation in the last 2.5 years, you can see that we've really focused on rotating all of our offerings, rotating how we deliver for our clients, and of course using it to operate ourselves.
But presentation, I mean, do you actually lose a valuable, you know, training for some of your workers in knowing how to do presentations, putting research together, which AI will now do for us?
Well, actually, we are really finding the opposite. By being able to use some of the work that is pretty rote, right, in terms of the presentations, we're able to mentor our young leaders about like the underlying, you know, content, you know, more, and they're actually able to focus to do more shadowing of, you know, senior leaders. What we are talking to every day to our clients about is what is their talent strategy? Because as you use AI to take care of some of those tasks, how are you able to leverage it to actually invest in their development and having a bigger impact and using AI to augment them?
Do you see AI as a way to cut costs or boost revenue?
It should be both. And where clients are focused only on cost, which is where we find a lot, they're actually missing the value. But one of the things that I think is a really important takeaway is that you cannot use AI to its full extent with their growth or value unless you're willing, going back to our earlier conversation, to change a lot more than, you know, we're seeing clients sort of think at the beginning. And of course, you know, here in London and Tech Week, this is a big topic, right?
It's a topic, and yesterday, and actually last week, we had also South by Southwest in London for the first time. We recently reported that, you know, Accenture resumed some of the promotions after pausing the normal promotion cycle in December. I mean, is your staff happy? How's morale?
Well, first of all, we're pretty excited that our EMEA business last quarter grew 8%, driven by the United Kingdom. So that is a, you know, real sign. And we did that on the back of investment. So, you know, just 18 months ago, we were talking about our United Kingdom business having challenges. It's now driving our growth. And actually, the UK is the number 2 country in the world in the last 5 years where we've done acquisitions. And, you know, we're used our investment over the last 18 months to really pivot to the areas of growth, like the defense sector. We bought 6.6, which is obviously a big focus for the government and the economy. And so we're really pleased with, you know, how our business here and in Europe is growing. And we are absolutely investing in technology and innovation and really being part of the fabric of the UK as well.
Why is the UK doing so well? Do you think companies need a little bit more consulting help to get in shape, or is it because it's growing?
Well, One of the things is that we are seeing the UK companies really want to innovate, going back to that leapfrog, right? They want to lead in AI. And, you know, one of the things I always talk about is that innovation cannot be done only within the four walls of any company, including Accenture. You really need to partner to be able to succeed. And, you know, we see from the government, from the Prime Minister to the companies, a real commitment. And we were super excited yesterday to be part of the announcement with about the 7.5 million people that we're going to be joining the 11 other companies to partner with the Prime Minister and the government to train. But that demonstrates a real appetite and commitment for the UK to be a leader in AI. And of course, there's phenomenal AI talent here.
Julie, overall, I mean, more broadly, Accenture and many of the rivals, of course, you know, have been dealing with a slowdown in business, certainly from the heyday of 2021, 2022. What's your strategy going forward to, you know, keep costs down and then grow maybe longer term?
The fundamentals of the industry are really clear. Every company needs to reinvent using tech data and AI. And so what we see is by being a leader in Gen AI in particular, this is helping fuel our growth. And actually, if you think about what's happening with the modern enterprise, is that, you know, 10 years ago, we were replatforming to be on the cloud. Right. Now, wherever you are from a digital perspective, you have to now adjust not just your technology and build a cognitive brain, we call it, for AI, but actually change every way you work. And in order to accelerate, clients need partners. And we have been the reinvention partner of choice. It's fueling our growth today. We have the largest numbers of Diamond clients, our largest relationships in our history. They've been growing faster in our history, and it's very much driven by the need to reinvent. So we see the industry as a long-term grower, and of course we're using AI to drive down productivity ourselves. And most importantly, though, we're using things like the Innovation Hub to be the leader in innovation, and that's what our clients are looking to us for.
Julie, thank you so much for joining us today. That was Julie Sweet, the Chief Executive of Accenture, joining us in London. Now, coming up, competition heats up in European capital markets as stock exchanges battle for listings. We'll speak to the Bank of America's Chief Executive for France. That's next, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Welcome back, everyone. Now, Uber and self-driving technology firm Wave plan to run their first trial of fully autonomous vehicles in London, paving the way for the two companies to launch commercial robotaxi services in the UK and beyond. Now, the companies did not name an auto manufacturer partner, but they did say they would share details on the global car company and trial timeline in the coming months. Well, Bloomberg's Tom McKenzie will also be speaking exclusively to the chief executive of Wave at the Founders Forum on Thursday. Catch that conversation at 6:40 a.m. London time. And remember, of course, as soon as robotaxis come in place, it changes everything for insurance, possible financial services as well. Now, staying with tech, and Apple has unveiled its most sweeping software redesign yet, big updates to its operating system and at its worldwide developers conference. But it did fail to impress investors who are looking for more announcement on the AI front.
As we've shared, we're continuing our work to deliver the features that make Siri even more personal. This work needed more time to reach our high-quality bar, and we look forward to sharing more about it in the coming year.
Matt Bloxham, Bloomberg Intelligence analyst, joins us now. Matt, we were all expecting, there's cool stuff, right? Like the liquid gas and some of the things that they announced. Yeah. I don't know whether we're just expecting more, but what would be the highlight of what you heard?
Yeah. Thankfully, no robo-taxis are announced. But yeah, I think obviously, I guess it is the slow light of, the kind of limited progress on AI. And as we just heard there, the Siri problems persist, and it's going to be a while before they sort those out. And that's, been a bit of a real bugbear for them and really lagging what you can get with things like Gemini. So yeah, the focus really on this kind of big overhaul of the look and feel of the operating system, not just on the iPhone, but across the whole suite of products, so that you're much more kind of consistent experience from device to device. And obviously, lots of people don't just have one Apple device, they have two or three. And, I think given this is a relatively kind of light year in terms of hardware upgrade for the phone, this kind of new look and feel and way of interaction with the device is really important to kind of underpin the perception that Apple users have and what they come to expect from the product. There clearly were some AI tools slipped in. So, for example, this kind of live translation feature now in the text messaging service. This is quite a kind of big step forward. And then they put things into messaging around kind of user polls and various other features like that. So AI is kind of slipping in. And I guess the other important thing they did on AI was to open their foundation models to third-party developers. So you'll see a lot more apps integrating that underlying technology. So a kind of evolution, if you like, of their AI technology, which is obviously very different to what we're seeing from their big rivals.
I still have to get to the bottom of why my teenager has more AI services on his Apple than, phone than I do, which is like, I don't know whether they're tiering or something like that, but Mama's not too happy about that. Is there anything here to actually drive iPhone demand?
No, I think it underpins the kind of the ecosystem, and it's certainly not going to detract people from continuing with an Apple. Apple customers are incredibly loyal. There's the fact that they're making these upgrades will kind of maintain that loyalty and stop people from thinking, well, maybe now is the time that I switch to an Android device to get better access to AI services.
Matt, thank you so much. As always, Matt Bloxham, their Bloomberg Intelligence analyst, joining us on iPhone and, of course, Apple. Now, don't miss the launch of our new show, Bloomberg Tech Europe, this Friday at 6:30 a.m. London time, of course, fronted by our Tom McKenzie. Now, Europe's stock exchanges are fighting harder to win listings as fewer companies choose to go public and others get taken private. This against the backdrop of political uncertainty in some European countries. Well, the French President, Emmanuel Macron, said yesterday that he has not ruled out the possibility of calling another snap election. Well, joining us now to discuss all of this, how the European markets can make themselves more attractive to companies and investors, Vanessa Holtz, Bank of America's France Chief Executive and Chief Executive of BOA Securities Europe. Vanessa, thank you for joining us. As always, how do you see this war to attract talent, but also M&A and IPOs? Who wins amongst the European countries?
I think France, because obviously I'm located in France, so I think it has a fair share, in a leading country towards Europe. I think a critical path to that is obviously France has to play a role, especially towards leading this continuous effort to establish a single market, including for financial services. And it is critical, and timing is absolutely key now for making sure that we mobilize Europe's surplus of private saving to finance long-term investment, for example, for the digital sectors. So I think France has a lead role. Attracting talent is very important. I mean, in France, we have a deep pool of talent, and I think across Europe, it has to play, obviously, his factors across Europe and across the world. So I think that's the moment, that's the timing, but we have to act pretty quickly in that sense.
Vanessa, have you seen any hit to Paris attractiveness? Because it's been also 1 year since, of course, President Macron has called snap elections in France, and that's led to a bit of volatility and uncertainty.
Yeah, it definitely created a temporary spike in uncertainty. Visibility is very important for market and stability. Although I think France has proven remarkably resilient so far. It remains obviously the first destination in Europe for foreign investor in 2024, and I think it might continue in 2025. So, as I said, even the volatility has been here, and whilst market needs clarity, it has attracted still some foreign investor. I think France has all of it. It has a very important financial ecosystem that is here, and it is remained to stay, and obviously still very competitive. We need, obviously, to act, as I was saying, on leading some single market union, but as well making sure that other bureaucracy and obviously some regulation are obviously alleviated in some ways.
Talk to me, Vanessa, a little bit about this volatility that has been created by a lot of the Trump policies, by a lot of the U.S. policies. Is this impacting where capital is being deployed? Is it impacting strategic decisions? And does it help Europe and therefore France?
Well, it has been impacting, obviously, as you know, some capital. But I think instead of saying that capital is exiting, I think it's edging. I think overall, the U.S. volatility isn't pushing investor out. It's pushing them to look wider. And I think what has been very important is not only solely focusing on U.S., but making sure that there is some sort of diversification, increased allocation on undervalued assets, especially in Europe, and with a clearer policy path. So overall, the volatility is being priced by the market. But so far, even the U.S. economy has been proven quite resilient. It's decelerating but not collapsing. Consumer spending increasing and continuing to fuel the economy. Labor market is still resilient. And obviously, we have a strong inflation. It's sticky, but it's controlled. So that has an impact on global growth and the economy. But I think overall capital still flowing. There is definitely a pause on the IPO and M&A market, as you mentioned. And again, I think there is a strong pipeline. Timing has been delayed for some of the transaction, but I think it can definitely continue going forward. And what is important and is great as an opportunity for Europe is back on investors' map.
Vanessa, when you look at AI, how is this changing the financial landscape? So how do you use it actually within your office, and how do you see it evolving in the future? Will it change the way you hire? Will it change the way you have to train staff?
I think AI is a critical path. I mean, we've been using AI, and it's been deployed, obviously, especially in the US with our Erica platform. And we're developing it at everyone and desk level to, for example, making research a lot more seamless, to respond to our clients' needs, to make as well, make productivity a lot higher, help, front office as well to deploy, obviously, capacities across the financial institutions. So I think the key point on AI is that it's going to help everyone to do exactly what they're supposed to do. That means to work on strategic decision, to work on strategic deals, and put all the admin work and the work that is very time-consuming on the side, and make sure that we focus on what is strategic and what is impactful for the company. It's been widely used. We continue to focus on it at each level on everyone's desk as well. And I think it's going to be a great improvement on the way we operate, on the where we focus, and creates more value for our clients.
Vanessa, when you look at the next 12 months ahead, I know you're also speaking on a panel on women in finance at Europlace a little bit later, but when you look at the next 12 months ahead, what do you think the biggest challenge for you and Bank of America France is?
Well, I think it's more an opportunity and obviously some challenge, but challenge create opportunity. We've seen that obviously post Brexit, and you mentioned France. Obviously, we've developed substantially a market share since we are in Paris covering Europe. So I think it's been a great opportunity. So going forward, we have obviously 700 people now working in France covering Europe, and we feel that we're going to continue to grow organically depending on our client needs. Our first and almost priority is to serve our client and to be there where they need us. So consistency is important, making sure that we offer them the scope of product that they need and tailor-made, obviously, the solution that they're expecting from us. So I think the challenge ahead is to make sure that we continue to be closer to our client, to make sure we can navigate within this volatile environment, and taking this as a huge opportunity, not only for France, but for Europe.
Vanessa, thank you so much, as always, for joining us. Vanessa Holtz, of Bank of America's France Chief Executive and Chief Executive of Bank of America's Securities Europe. Now, up next, we'll have Bloomberg Brief. Of course, a lot of the focus will not only be on some of the Fed speakers, but what we're seeing in markets. Now, futures hover pretty much unchanged because of these U.S.-China talks here in London. UK stocks hitting a record. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know. Still talking, U.S.-China trade negotiations continue for a second day. We are live from Lancaster House in London. The 4th day of unrest. President Trump deploys additional troops as anti-deportation protests spread beyond L.A. And the AI race ramps up. Meta forms a superintelligence AI group while Apple expands its deal with ChatGPT. So we were a little changed yesterday on the S&P, and as fate would have it, We're little change yet again this morning. What is going to excite these markets? There's a lot of risks on the horizon, from trade talks to CPI to bond auctions. We are still just 2.3% away from all-time highs. There's a little move in treasuries yesterday, too. In fact, it was the slimmest daily trading range for treasuries in 6 weeks. What do we get? We get a rally this morning. We're down by about 2 basis points, down by about 2.5 basis points for your 10-year yield at 4.44. Let's now get you some stocks to watch here. With that this morning is Bloomberg's Joe Easton. Hey, Joe.
Morning, Danny. So Novo Nordisk shares edging higher this morning. This after the Financial Times reports that Purvis Asset Management, a hedge fund and an activist, has bought a stake in the weight loss drug maker, and that is pushing the shares up higher. According to the report, they're going to look to potentially have an influence on who Novo appoints as their next chief executive. It's a bit of a sentiment move on that one. Then a bit of a segue on the next one, because McDonald's downgraded today over at Redburn, and we're seeing this stock declining around 1.3%. Redburn writing a note that GLP-1s, weight loss drugs, are going to see people cutting back on all of their Big Macs and other burgers as well. I quite like their katsu chicken wrap. That's a new one for me. But McDonald's downgraded today. They've also got a sell on Domino's Pizza due to the weight loss drug worries. And finally, a quick check back on Apple. Slightly lower once again in the pre-market following that update. Well, it's just ticked green. That's just my luck, isn't it? But that follows disappointment on that AI news at the event in California yesterday. And as usual, check out on the terminal the before the bell opening wrap, summing up all of these moves and more, Danny.
Oh, man, I'm also a sucker for a katsu wrap. I think it might only be in the UK, though. I need to come visit, Joe, and get my hands on that.
You need to come over. It's the perfect reason to come back to London.
I'm sure our bosses would agree that that's a good reason to send me there. Joe, thank you so much. Joe Easton, we'll catch up with him later in the hour on those movers. And in just moments, Ella Hoja of Newton joins us for her read on the bond market. Later this hour, we'll also look ahead to Wednesday's CPI data with State Street's Kayla Cedar. Now, Newton's Ella Hoja weighing in on the question of, are we at peak fiscal concerns? She writes, quote, bonds and credit price a soft landing. So there is room for surprises to the downside there. But for the time being, volatility remains contained. Ella joins us now, head of fixed income at Newton Investment Management. And contained it is, Ella. We are barely moving yesterday and today. A lot of risk between CPI, trade talks, and auctions. What do you think could move the needle this week?
Yeah, I mean, we were quite sensitive to the labor data that we got last weekend, so last Friday, and so that probably caused a bit of, a bit of a relief, I guess, for the short positions in rates. I mean, going forward, we're still sensitive, I would say, to data, but at the same time, what is the talk du jour? What's the topic of the day? It's very much around the fiscal concerns, and hence why we pose the question: are we at peak fiscal concern, at least for the short term? Structurally speaking, we don't think we are, but for now, for the next few weeks or months, if you like, we could see some relief, I think, on that end.
That's even interesting, Ella, because it feels like every day there is a different driver on the fiscal side. It's one day it's trade, and that seems to be the focus today with these talks in London, or it's the one big beautiful bill making its way through Washington, D.C. Given what you're saying, is it the one big beautiful bill that is more important to these markets than what's happening in London right now?
I would say so. I mean, in the sense that for bond markets, this is pretty much a contentious point, and we've discussed this a few weeks back in a different show with Bloomberg. But broadly speaking, the breaks in precious metals are very interesting, right? So you saw palladium yesterday cause a major break. You had silver probably last week into this week. So you're having some major breaks in precious metals that are telling you that there is some diversification away from bonds, which typically play safe value, and going into precious metals, which are probably, perceived, at least from investors, as a better store of value in this kind of environment we're operating in, where fiscal concerns remain elevated. So I think that's quite an interesting development for markets.
But Ella, how do you have on one hand this break for precious metals, a gain there, and credit spreads still tight, equity risk markets close to all-time highs? Is there not a tension there?
Yes, I mean, but if we think about it, I mean, data hasn't been terrible. So the economy is still, trotting along, as we say here in the UK. In terms of inflation, no one seems to be utterly concerned at this juncture. and we passed that sort of peak fear period that we saw over the month of April. And of course, sentiment got very bearish leading into that and following that immediately. And so when you look at credit, perhaps the view from investors is it's not government debt, right? So they feel they're lending to corporates that have better balance sheet than a lot of governments do right now. And so it's not entirely irrational right now. Should you price 20% odds of recession, perhaps you can question that. Maybe that should be higher because the tail, as we argue, the tail risks have gone up on both directions, whether it's this fiscal concern on the bond market or whether it's this growth concern on the other hand, where we're due a correction on the growth side, for some time now. So look, with those bigger tails to us, it feels like it's the environment where you probably want to run a little bit less risk, but it doesn't necessarily mean you turn outright bearish on credit or on equities here. I still think bonds will lead the charge here, by the way.
Ella, Torsten Slok yesterday made the argument that now that half of all debt issued in the U.S., half of all fixed income is coming from the government, that it will crowd out investment into the private sector, into the consumer sector, because you have more dollars needing to chase all of that coming out of the government. Is there a one-to-one relationship? Is that an issue, the supply, not necessarily just driving yields higher, but taking money away from corporate credit?
Well, it hasn't been the case so far in the sense that corporate spreads have, as we discussed, have remained very well behaved, and there's been lots of demand from our clients coming into credit funds. So that's not been corroborated. Now, of course, if in the future, as we anticipate, term premium in bond market is going up and continues to do so, and bond investors demand more yield to lend to governments, that will filter through into corporates as well. That goes without saying. But perhaps we are in a different regime, right? This regime is one that is really very much driven by these fiscal concerns, and so it's govies that drive that. But at the end of the day, governments can tax corporates, and it's not the other way around. So you have to be cautious how far you push that argument.
Ella, you mentioned at the start of this that, of course, the data matters. The data has been really patchy, but I want to ask what you think of what we got from the New York Fed inflation survey yesterday. Inflation expectations dropped by 0.4%, which essentially erases all of the pickup in expectations that we saw after Liberation Day. What do you make of the survey data? At least just given from the Fed consumer survey, things seem to have improved from a sentiment measure.
Yes, because sentiment was very much driven by policy, was driven by tariff fears, and that's how we got into this extreme sentiment surveys. And so it makes sense to unwind some of that. Long-term inflation premium or pricing in markets didn't shift that much. It was more the short-term stuff. So it makes sense to get some stabilization. But, when you look at bonds, I don't think you see much priced in terms of inflation risks down the road. And we would argue medium-term inflation concerns should be higher than they are currently. And the reason for that is quite simple, is this fiscal story we're discussing, right? So if you're going to try to stabilize yields, you're going to run more risk on inflation over the medium term, and we're talking 2 to 5 years. However, over the short term, you're going to be seeing these bouts of sentiment extremes, just as we saw in 2021, 22, and just as we're seeing this year as well.
Surely some of what we're getting from the corporate side, Ella, they can't just keep absorbing price increases. We saw the effective tariff rate, new data coming in about 7%, which is much higher than it had been. There have been announcements from Ford, from Hermes, about lifting their prices. Of course, not everybody is going to be going out and buying a Birkin bag. But Ella, when we get things like CPI, is there a risk that goods inflation is going to start to show up already?
I mean, look, I think over the short term, yes, certainly in the U.S., it's more prevalent. We are not concerned in other markets. I think the opposite is true in Europe, out of Asia, particularly in China. So you have the opposite problem. There's a bit of an inflationary dynamic going on in Japan that goes without saying, but those are more exceptions. So yes, pertinent to the U.S., you can see some of that. But relative to what expectations got to in the month of April, we're still in a better place. So I don't think inflation is the driver for bond markets right now. It might be the case, but I think that's a much later story. We're talking 26 onwards. So I think for now, it's very much this, who's going to pay for this fiscal spending, and, what will central banks do in response to any sort of growth shocks that we might get over that period. I think that's kind of like the big mover for markets right now.
Ella, we will keep an eye out for that big mover. Thank you so much for joining us this morning. Ella Hoja of Newton Investment Management. Now let's get you some other top stories that are trending on the terminal this morning. Russia unleashed a sweeping drone attack on Ukraine, hitting Kyiv and Odessa. Ukraine's Zelensky said the attacks resulted in fatalities and at least 13 injuries. Russia and Ukraine are currently undertaking a major prisoner exchange after peace talks last week. A venture capital fund backed by Fidelity's Johnson family is looking to unload its Chinese tech holdings. Bloomberg sources say that Abigail Johnson's family VC, 8 Roads, began exploring the sale of all of its investments in about 40 Chinese companies in the face of rising tensions between the U.S. and China. The firm was an early investor in China's internet sector. Elsewhere in China tech, the founder of Huawei has dismissed the impact of Washington's curbs on American semiconductor exports to China. In an interview with the Communist Party's official newspaper, he said domestic firms could resort to chip packaging or stacking to get results similar to using advanced chip technology. Export controls are on the agenda in negotiations between the U.S. and China in ongoing trade talks in London. Now, speaking of that, it is day 2 of the negotiations happening in London. We're live from Lancaster House. We'll bring you that next on your Bloomberg Brief.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. The biggest names in business choose Bloomberg Television.
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We are doing well with China. China's not easy. We want to open up China, and if we don't open up China, maybe we won't do anything, but we want to open up China. It'll be a great thing for China, a great thing for the rest of the world.
U.S.-China trade talks continuing into a second day in London. After 6 hours of discussions on day 1 yielded no apparent breakthrough. Joining us now is Bloomberg's Anne-Marie Hordern, who is live from Lancaster House. Anne-Marie, great to see you this morning live from London. Where do we stand on these negotiations?
Good morning, Danny. Well, the delegations have yet to arrive. We're still waiting for the Chinese delegation to arrive. That's being represented by Vice Premier He Fang, as well as the U.S. delegation, which really the driving force behind that is Secretary Bessent, the Treasury Secretary, who yesterday when he was leaving the meeting, and we shouted some questions at him asking how the meeting went, he said it was a good meeting with a thumbs up. Commerce Secretary Howard Lutnick, who's in addition from the Geneva talks, said the meeting was fruitful. Where we stand here today is basically trying to understand the parameters of what each Beijing and Washington are willing to concede. We do know that the U.S. is asking Beijing to have a more advanced pace when it comes to things like rare earth minerals and magnets, which is critical for the technology industry and the defense industry. For the United States, they have signaled that potentially there would be an easing of export controls, which makes sense why Commerce Secretary Howard Lutnick is at these talks in London. The question is, what is the line? Our reporting is that potentially these are recent export controls, things like chip design software, potentially some nuclear materials. The question, of course, becomes what is the red line and what does it mean for export controls going forward? Kevin Hassett did signal they wouldn't go as far as those advanced chips, those H20 chips from NVIDIA, that NVIDIA made to be Chinese compliant, Danny, during the Biden administration.
Well, we even heard from the Huawei founder who said the tech's not that important to us coming from the U.S. Anne-Marie, does it seem like China has the upper hand just given that?
Potentially, and we saw that actually, Danny, you were one of the first individuals to report about this when it came to DeepSeek. And I spoke to Jensen Huang just a few weeks ago before he went into the Oval Office to see President Trump. And I asked him, how far behind is China when it comes to the advanced chips and advanced technology? He said China is not behind. They are very, very close and basically saying they are right in lockstep with the United States when it comes to developing these chips. So it does seem that China has workarounds, but of course, this becomes a question going forward. If the United States is willing to give on in things like export controls, what becomes then the red line for national security, and what does it mean for export controls going forward? This meeting in London is really about de-escalating only the escalation we saw the past 4 weeks, getting back to those Geneva talks.
Yeah, it just shows you that the full slate of issues, getting through them is going to take some time. Anne-Marie, excellent reporting. We'll catch up with you later in the hour with any developments. That is Bloomberg's Anne-Marie Horjern live from Lancaster House in London. Now let's stay with tech. But elsewhere, the AI race is ramping up. Mark Zuckerberg is said to be creating a new super intelligence team at Meta that, according to Bloomberg sources, the goal is to overtake other tech companies in the space and achieve artificial general intelligence, the notion that machines can perform as well as humans at many tasks. Joining us now is Matt Bloxham of Bloomberg Intelligence. Matt, when I first saw this story, my first question is, how is this different than what Facebook, than what Meta is already doing?
Well, I think the fact that it's around artificial general intelligence rather than generative intelligence is the big thing here. It's really looking at, I guess, the kind of mid to long term of where the AI industry is going and making sure that they are a leading player in that. And this really kind of complements all the other work they're doing on things like Llama, for example, their foundation model, which is very much in their products today. This is about thinking about the future and this kind of next level of artificial intelligence, which will be, like I said, maybe 3 to 5 years before it actually becomes something that's part of their products.
So that's Meta, maybe as a way to get investors excited. Is Apple a lesson in their developers conference, Matt, in how not to get investors excited?
Yeah, I think that's a fair point. But I think Apple, again, is a company that kind of does its own thing its own way and kind of plays for the long term. And I think, whilst there wasn't any kind of big showy announcements around AI, there were lots of little things dripped into their products. For example, the live translation that's now in messaging, the kind of intelligent suggestions that maybe you want to ask a survey in a group chat, things like this that they're dropping in, which are evolutions for them, and that they're putting products into their offerings which are kind of really high quality and they know that they work. And that's why we heard yesterday that they continue to push back an update to Siri because they're not happy with the quality of the developments they've made. So that frustrating for investors, frustrating for customers. But I think they're doing just enough to keep customers engaged with the platform to avoid them churning to an Android.
Matt, it was the last developers conference that we saw this announcement of a new Siri, and then it goes by without a mention of it. Is there some degree which they're trying to set the bar lower just because it is taking them longer to avoid the disappointment of what we had last year?
Yeah, I think so. And obviously, we've seen some of their rivals struggle with the latest releases of their own AI updates, including Meta. So I think it's not straightforward, these investments in AI. And I think I'd say with Apple, everything is about quality and seamless integration. So I think that they're really focused on making sure that the enhancements they put in to the iPhone and their other devices really kind of meet customers' expectations, which are very high.
Well, when it comes to one of their main suppliers, TSMC, Matt, had earnings where they showed their revenue surging by 40%. Of course, they're a big supplier, not just to Apple, but NVIDIA. Does this just underscore the insatiable demand for AI?
Yeah, it does. And obviously, that there was a specific dynamic behind that 40% growth in May, and it was a bit slower than the 49% in April. And really what we're seeing is customers stockpiling technology for fear of what curbs are going to persist given the China-US trade war that you were just talking about. So I think, that's kind of reflection. I think that's going to remain strong into June too. Obviously, if we do see breakthroughs on things like the rare earth minerals and also the US easing trade embargoes on technology into China, that may temper people's stockpiling, but actually it will kind of bring back more natural demand. So I think, the demand and appetite for AI is pretty insatiable right now, driven primarily by the kind of really, really big tech firms. But, there's a kind of big, long tail of sovereign investment and smaller corporate investment coming through too. So I think the demand outlook looks pretty strong for now.
Matt, thank you very much for that update. That is Matt Blocksom of Bloomberg Intelligence. Now, coming up, there is one major story on the front pages of all your newspapers this morning. President Trump deploying active duty Marines to protests in LA. We'll have the details next on your Bloomberg Brief.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
This is Bloomberg Brief. I'm Danny Berger in New York. Let's get you some front page news, what's making headlines at major publications. And for the second day across the country, there is one story dominating the front pages, and that is the protests in Los Angeles. About 150 people have been arrested in LA since Friday. Police have been using tear gas and less lethal ammunition to disperse protesters. The latest development, the Pentagon's move to send 700 Marines to LA. They will join the National Guard troops already in the city. The New York Times writing that the president is pivoting from his feud with Elon Musk last week to focus his political ire on California Governor Gavin Newsom. Newsom said that he would sue the administration over the planned use of Marines. The Financial Times, meanwhile, reporting that a growing number of military veterans are objecting to Trump's interventions in L.A. A Marine Corps veteran called the move a major shift in civilian military norms and a dangerous precedent. Now, quick check on markets as we head to the half hour. The S&P 500 just trying to trot along. Little change, very common markets. What changes that? It is day 2 of talks in London with CPI tomorrow and bond auctions on deck. Coming up, we'll push ahead to that inflation data. We'll catch up with Kayla Cedar of State Street.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read?
It's a challenge with the digital age because people they're reading on tablets, so we do count that as reading. If you have an e-book, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries as, and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know. Still talking, U.S.-China trade negotiations continue for a second day. We're live from Lancaster House in London. The 4th day of unrest, President Trump deploys additional troops as anti-deportation protests spread beyond L.A. And the AI race ramps up. Meta forms a superintelligence AI group while Apple expands its deal with ChatGPT. Still, those things uninspiring for a market that is going a whole lot of nowhere. S&P and NASDAQ futures little change this morning after being little changed yesterday, still 2.3% away from all-time highs. Meanwhile, for your bond market, we are looking at slightly lower yields, about 2 basis points across the curve. More easy inflation expectations coming from the New York Fed survey. We also have CPI tomorrow and bond auctions, so plenty of catalysts for this market. Let's look at the individual catalysts. Back with us with your stocks to watch. Here is Joe Easton. Hey, Joe.
Hey, Danny. So Novo Nordisk getting a boost today. The ADR is rising around 1.6% at the moment. The Financial Times reporting that Parvis Asset Management has bought a stake in the company. We don't actually know how much they've bought, but the company is said to be pushing for some influence on who Novo appoints as its next chief executive. That is Parvis's intentions, according to the report. So we're getting a bit of a boost on that stock today. Then we've got a bit of a segue into food stocks because we've got a downgrade for McDonald's. A fascinating note out from Redburn this morning on the restaurant space, which is actually named Hunger Games. So appreciation for that naming of that note. But they're talking about how the weight loss drugs made by Novo Nordisk will actually reduce consumption of McDonald's, also even hitting potentially Domino's Pizza. So we're seeing a downgrade on both of those stocks today, and both of them low. We can see MCD falling around 1.3% following that note there. And then finally, a quick look at Uber, because a report saying the company is going to start trialing robo-taxis here in the UK. So some excitement for us on that one. This is with a SoftBank partnered firm, potentially going to be launching here in London. Uber shares heading around at 0.6% higher this morning. Danny.
Joe, thank you very much for that update and for your work this morning. That is Joe Easton. Now, it is a busy calendar, as I mentioned. The first roadblock ahead is U.S. CPI data. That comes on Wednesday. State Street's Kayla Sater writing in on the recent data, writing, quote, inflation data as of late has shown a balancing act, and we are wary of how long that can continue for. Joining us now is Kayla, macro multi-asset strategist at State Street. Kayla, does it continue on for some time? Are you expecting the CPI data to show any of the inflationary impact of tariffs?
Hey, Danny, thanks so much for having me today. Yeah, you know, it's interesting because we do see tariff impact on specific sectors. So one thing we're able to do is we can see prices every day. And when we look at different sectors, we do see very high prices in terms of electronics, in terms of household products, and we are starting to see some rises in apparel as well.
Hey, Kayla,
So
I'm just going to
it's
take a
definitely
break
paying
right there. We'll get back to you, but I just want to go over to London now, where Anne-Marie Hordern is standing by as Representative Jamieson Greer enters the talks. Let's have a watch and a listen.
Good morning, Danny. That's right. Ambassador Jamieson Greer just entered the building at Lancaster House. This is the second day of talks. We did have the Chinese delegation arriving about 10-15 minutes ago. That was led by Vice Premier He Fang. We're still waiting for Commerce Secretary Howard Lutnick and Treasury Secretary Scott Bessent, who is leading the U.S. delegation, to arrive. But Ambassador Greer is in the building. Of course, he's the USTR ambassador, former chief of staff, of course, to Robert Lighthizer of Trump 1.0. So he was there for the first trade war with China and the phase one trade deal. Again, we're still just waiting for Secretary Bessent to arrive and Secretary Howard Lutnick from the Commerce Department. More U.S. staff is arriving, Danny. It's the second day of these talks. Remember, they met yesterday. These talks, basically recalibration of what we saw from the U.S. and Chinese delegations in Geneva. There was some escalation following that Geneva meeting. President Trump and Xi Jinping got on a phone call together, and that really led the path forward for having these talks today here in London. And actually, Danny, I do see Commerce Secretary Howard Lutnick. Commerce Secretary, how are the talks going?
How are the talks going?
We're live on Bloomberg right now. How are the talks going?
We've been all day yesterday, and I expect to do all day today. So they're going well, and we're spending lots of time together.
Thank you, Mr. Secretary.
Thank you, Mr. Secretary. Danny, I'm not sure if you heard there, Commerce Secretary Howard Lutnick, as he enters Lancaster House for day two, said they talked all day yesterday, which is true. We were here till about 8:30 p.m. local time, and he said they're planning on talking all day today. He said the talks are going well. We should note that Treasury Secretary Scott Bessent has to be back in Washington, D.C. tomorrow because he's testifying on the Hill. So the talks have to end today. We are seeing good optimism, though, when you hear from the Commerce Secretary. It looks like Treasury Secretary Scott Bessent has also just arrived. We are waiting to see him get out of his car. He's the last one to arrive. Treasury Secretary, how are the talks going? Secretary Bessent, how are the talks going? All right, no talk from Secretary Bessent on the way in, though, but we did hear from Commerce Secretary Howard Lutnick just a moment ago saying he thinks the talks are going well, and they plan, Danny, to talk all day today. I'm just going to get back into position here. So now we have the full teams in place, the Chinese delegation and the U.S. delegation, both behind me in Lancaster House for day 2. Quick recap of what each team wants to see. Beijing wants to see an easing up of those export controls, Danny, and the United States wants to see an advanced pace of those rare earth and magnets.
Anne-Marie, excellent work. Thank you so much for your coverage. And again, the Commerce Secretary Howard Lutnick responding there to Anne-Marie Horder and saying that the talks are going well and that he anticipates that they go all day, much like they did yesterday. Kayla Cedar of State Street is still with us. Kayla, I don't know if you heard much there, but of course the Commerce Secretary saying that the talks are going well. What is the bar for this market to continue trade optimism, to continue to rally with what we get out of London, which of course is where you happen to be right now too?
Yeah. You know, you're right. The bar is starting to get higher because we are starting to see good news being priced in. One thing that's really interesting, though, when we look at our flow data and our holdings data is that actually tech hardware is one place where we haven't really seen investors come back into that space as much as they have other kinds of sectors and industry groups that are exposed to this tariff trade. So I would say, positive news could be a pro that hasn't been priced. That's something we're keeping an eye out for.
Elsewhere in tech, not the hardware space, but the hyperscalers, the Mag 7, Kayla, it does feel like it's been the fuel for this market. We learned that Facebook, that Meta today, is spending more money on trying to build artificial general intelligence. Apple trying their hardest to catch up too. The CapEx has been remarkable there, where everything else has slowed down. Are we going to get back into an environment where those types of names become something of safety, become something of a haven, with other companies starting to slow down given the uncertainty around trade?
I think that's right, especially given where we are with interest rates, right? So because rates are staying elevated and the Fed isn't in a rush to cut rates, it means that this supports more concentration because the companies that we've discussed, kind of these general themes of these large cap companies that are able to continue to produce on the CapEx front and invest in these really growth factors are companies that have strong balance sheets and are able to navigate an elevated rate environment. It's companies that don't have the same access to funding and have higher costs of investment that are going to struggle in this kind of environment, which supports continued concentration.
On that higher cost of funding, how vulnerable are we to continued higher rates? Is it still a period of extend and pretend? Defaults have been relatively low, Kayla. Does that change?
I do think this period of extend and pretend is going to continue for now. When we think about, especially bringing it back to the inflation conversation, things we're keeping an eye on are that, we're kind of in this balancing act right now where you do see upside price pressures in certain sectors, but that's being counterbalanced by lower energy costs. And if that dichotomy doesn't continue, we could see upside for inflation, which means that we'll continue to see cut expectations being pushed out further.
Well, to that point, you have seen some of the consumer sentiment measures come in, Kayla. Yesterday, you had the New York Fed survey where you did a round trip on inflation expectations. It dropped, and giving back what we did see as the uptick in April after Liberation Day. Can you even trust these sentiment measures, Kayla?
The sentiment measures are, certainly a little all over the place. I would say one thing that we're really focused on when it comes to inflation expectations is not so much consumer sentiment expectations, but market sentiment expectations, especially keeping an eye on those longer term break evens. So thinking like 10-year break-evens, things like that. And those have been incredibly stable. And so for the Fed, this is really important because this is a sign to them that longer-term inflation expectations are still anchored.
Okay, so if we still have anchored inflation expectations, does it matter for the Fed that the data we get in, the CPI tomorrow, Kayla, it is a Fed that is not concerned necessarily about the here and the now, but where inflation goes going forward because of trade, because of tariffs?
Yeah, I think what this means is that moving forward, the Fed is going to have to, of course, they're data dependent. However, I think what the market will end up doing is you can kind of look through some of the data in the short term because there's still these catalysts that we have to see how trade negotiations are going to work out. We have to see, there's a lot of uncertainty out there, and I think we've heard that in the Fed's rhetoric. So therefore, their default is to remain patient. And so I think that's the messaging that we'll probably get in a couple of weeks from them.
Meanwhile, for the bond bears, they get excited about the auctions, Kayla. Tomorrow we have a 10-year auction. The following day, a 30-year auction. The auctions since Liberation Day have been fine. Maybe not fine in Japan, but for the U.S., for the most part, the auctions have been fine. Is there any reason to suggest that that might change?
Yeah, we're keeping an eye on auctions. And like you mentioned, auctions have been pretty okay recently. And so I think what this means moving forward is, yes, there's going to be a lot of focus, especially on that 30-year auction. I would say, looking at the auctions last month, if any were relatively weak, I would say it looked like the 30-year. But again, the picture was still okay in aggregate. And so this is something that we're definitely going to keep an eye on. When we look at our real money data, where we see preferences across the curve is for the front end. And so that's why it's so important to look at what's happening at the long end. Do we continue to see a lack of demand there? And will there be any signs of weakness? So far, we haven't really seen that just yet. But with that said, we see a preference to stick at the front end of the curve rather, which makes sense if the Fed is in this place of pause for now.
Kayla, it is so wonderful to see you. Enjoy the rest of your time in London. Please come join us again when you're back in New York City. Kayla Cedar of State Street. You're watching Bloomberg Brief.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
You're watching Bloomberg Brief. I'm Danny Berger in New York. And the Trump administration has escalated its response to the anti-deportation protests in L.A. 2,000 additional National Guard troops and 700 Marines have been mobilized, deploying active duty military on the ground after a fourth night of tensions between residents and authorities. For more, we're joined by Bloomberg senior editor Bill Ferries. Bill, what is the latest in L.A.?
Hi, thanks for having me, Danny. We've seen a caravan of buses heading from 29 Palms, the military base, to Los Angeles, carrying those estimated 700 Marines who the president has ordered to be deployed, alongside up to 2,000 National Guard troops who have been also authorized. On the ground so far, we've only seen about 300 of those National Guard soldiers protecting kind of some of the federal buildings there in Los Angeles, but tensions remain high. It was a little bit calmer last night in Los Angeles than it was over the weekend when we saw those Waymo cars getting burned and some of those really dramatic clashes between the protesters and police and National Guard. It was a little quieter on Monday, but the war of words between President Trump and Governor Gavin Newsom has really continued and escalated. California is now suing the federal government to try to get them to take back those National Guard and military troops that have been sent out. We'll have to see how tensions flare up or de-escalate in the coming days and the week ahead.
Elsewhere in Washington, D.C., it's a busy agenda. The one big, beautiful bill is still now making its way through the Senate. And, Bill, we've seen House Speaker Mike Johnson trying to urge the Senate not to change anything about the SALT deal that they've reached. What is the risk that there is a change to SALT by the Senate?
Yeah, so that's the state and local tax deductions that are so important to a lot of Republicans, particularly in places like New England, New York, California as well. There was a limit of $10,000 under current legislation. The bill that went through the House, narrowly passed the House, would raise that deduction to $40,000. So when you're looking at a $10,000 base and a potential $40,000, some Republicans in the Senate see a lot of room for negotiation there. That's a line that Mike Johnson is saying Senate Republicans shouldn't cross, but it's hard to see that 40,000 level sticking in a final draft out of the Senate. That means it would have to go back to the House. Of course, the margin of the Republican margin in both the House and the Senate is really narrow. So even a small thing like this can have big consequences on getting that bill to President Trump's desk.
Bill, we really appreciate your reporting this morning. That is Bloomberg's Bill Ferries. Now, a Bloomberg scoop, Meta is recruiting a team of AI experts. It's calling a superintelligence group to try and win the race against other companies and achieve artificial general intelligence. For more, Bloomberg's Tom McKenzie joins us now. Tom, Meta has already been spending billions. How does this differ from what they're currently doing?
Well, it really underscores, I think, Danny, according to our reporting, just the urgency with which Mark Zuckerberg is now taking the race towards AGI, or human-level intelligence on AI, and feeling that, in fact, Meta is playing catch-up at this point, particularly versus OpenAI and Google. And that is why, according to our reporting, he is putting together a team of about 50 superintelligence at the brain trust that he is hand-picking himself. He's been having conversations in his own homes around the US and California to try to persuade key researchers and key engineers to join this team to accelerate that move to AGI, which he then wants to bed into their AI services, into their chatbot, even into their Ray-Ban glasses as well. And part of the pitch that Musk has been making to these key names that he wants to put together is, look, we have the financial resources. We don't have to go out and fundraise. That's a bit of a nod to OpenAI. We have our own capital, our own financial resources from the advertising business, which is still very robust, and we can channel that into the data centers and the infrastructure. And he thinks they should and could be winning in terms of that race towards AGI. Disappointed about Llama 4, the most recent model. They've delayed another model as well in terms of the performance and the uptake. And this is Musk's, or I should say, Zuckerberg's response to this story. He's also invested, according to our reporting as well, looking to invest about $10 billion in scale AI. That's the focus on data. So he wants the data piece, and he wants the engineers and researchers to be able to implement and get to AGI ahead of those competitors.
Tom, you're forgiven for saying Musk because everybody is throwing money at this. Everybody is spending heavily. And on that note, Apple has been one of these companies that we've been looking at. How is their spend paying off? They had their Worldwide Developers Conference yesterday. Tom, is this a conservative Apple that we heard from this time around?
I think that's the right way to frame it, actually, Danny. And we talk about a gap, and we talk about the competitive gap that has opened up between Meta and OpenAI and Google. Well, it's certainly there when it comes to Apple and its ability to integrate AI solutions across its hardware devices. What it did do, and what they did announce yesterday, was they're going to be building and deepening that relationship, in fact, with OpenAI. So on the infrastructure side, powering some of their AI solutions, that deeper partnership is going to be a benefit. But what they haven't done is come out with a bazooka announcement, for example, around reworking Siri to integrate AI into that product that is really going to drive demand. At least that's a view from analysts. UBS analysts, for example, saying the announcements, and I'm paraphrasing, were piecemeal yesterday. I'm not paraphrasing here. UBS saying it's unlikely to change the demand dynamic in terms of upgrading your phones from Apple's consumers.
All right, Tom, thank you so much. We really appreciate your reporting this morning. That is Bloomberg's Tom McKenzie. Now, coming up, I'm going to scurry away to the surveillance set, but Bloomberg's Anna Edwards is going to be getting you set up for your trading day and your day ahead. A lot on the agenda, not just for today, but for this week between CPI and bond auctions. That's coming up next on your Bloomberg Brief.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Anna Edwards here in London. Now a look at what is ahead for today. The NFIB small business optimism data coming at 6 a.m. Eastern time. How will that stand up in the face of all the uncertainty created around trade policy and other policy areas? Then Defense Secretary Pete Hegseth testifies to an oversight hearing before the House Appropriations Committee. That is at 9:30 a.m. And also on the agenda, GameStop earnings come after the market closed. So that's one of the corporates that we will be keeping an eye on. Let's have a check on the markets for you. This is the picture on U.S. futures. Not a great deal of movement in the U.S. futures picture. We are waiting for any headlines coming out of those trade talks between the U.S. and China. The U.S. dollar is on the front foot a little bit this morning, and the U.S. 10-year yield just moving by 2 basis points, as you see, as we wait for an auction. That's one of the big set pieces, I suppose, of the market week. Still to come, that and U.S. CPI data. On the European front, then, this is the market that hands over to you guys in the United States. The FTSE 100 actually touching a new high, up by 0.4% this morning. Part of that being driven by some weakness that we have had in the currency. The pound is actually down by 0.5%. But we also had some slightly disappointing data around the labour market picture that's weighed on the pound, increased dovish expectations around the Bank of England, and the DAX on the back foot, that on the back of a Bank of America note, suggesting that maybe we've travelled a little too fast, too quickly on some of those defence names that have been attracting a lot of attention in the German market. Let us tell you, here in London, we are watching Lancaster House, the 19th century building where we see US and Chinese negotiators gathering to talk about trade. We've already heard from the US Commerce Secretary, Howard Lutnick. He was taking questions from Bloomberg surveillance Anne-Marie Hordern, who was outside that building, and he said that the talks are going well. They are expected to go all day Tuesday. They went all day yesterday, of course. We'll see whether they manage to get to any narrow conclusions around rare earths and tech, or any broader conclusions on the trade agenda between these two nations. That is certainly going to be a big focus for markets as we go through this trading day. That is it for Bloomberg Brief. Surveillance with Danny Berger is still ahead. This is Bloomberg.
We're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services companies. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. But in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Right now, we're witnessing a fundamental repricing.
The market has got, to some extent, I would say, desensitized to the daily gyrations in the numbers.
The markets have been very tolerant to a lack of concrete tariff progress.
Tariffs at this point in time, I think, are just overstated. The fear is more important than the fact.
Ultimately, we will break to new highs.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday, nothing good comes easy.
We are doing well with China. China's not easy. China has been ripping off the United States for many years. Nobody charged them 10 cents. No president had the courage to charge China for whatever reason.
Trade talks between the United States and China enter a second day in London as the US signals a willingness to remove restrictions on some tech exports. Officials are still pushing China to ease limits on shipments of rare earths. We're gearing up for another full day of talks in the British capital.
And I think it's important to emphasize that this is just on rare earth metals and technology. It underscores and it's a reminder that the process of getting through all of the trade issues, the full slate, is going to take some time. The fact that here we are on day 2, and you're only really hearing from the U.S. side saying we're making progress. From the Chinese side, it's we're staying principled.
They've been very quiet. We've talked a lot about this over the last several months or so. It feels like we're escalating just for the sake of de-escalating. We're taking one step back and then taking one step forward. But ultimately, these talks have gone nowhere. And I think of the president's first term, it took 18 months to make a phase 1 deal. How much more of this can we take?
And at that point, they were just dealing with China, too. Recall that we also have in July the 90-day pause for reciprocal tariffs coming up, too. But it begs the question of who has the upper hand at this moment. We heard from the Huawei founder saying, actually, U.S. tech isn't that important to us. For the U.S., rare earth metals are so critical to things like the auto industry. So maybe the U.S. has more to lose in these conversations.
How nice is this, Danny? It's all relative, but it feels like a summer Monday into a summer Tuesday. Tight trading ranges, narrow stuff.
Go to the beach kind of day, which I think we would all appreciate. But you can't really relax when you have these trade talks going on. You have U.S. CPI tomorrow, and you have a 10- and 30-year auction on the slate. There's a lot that could upend these very calm markets.
We'll take a summer Tuesday into Wednesday, to Danny's point, CPI, into Thursday, PPI, 10-year supply coming tomorrow, 30-year supply coming a day after. A lot still to come this week. Equity futures at the moment just about unchanged on the S&P 500. No drama there. Coming up this hour, we'll catch up with Sundar Sundar of JP Morgan as stocks post back-to-back gains. We'll also catch up with the former Trump White House trade official, Kate Kalukowicz, and Michael Eng of Goldman Sachs as Apple fails to impress. We begin this hour with our top story. White House officials striking an optimistic tone as US-China trade talks continue for a second day. Anne-Marie joins us now from Lancaster House on day 2. AMH, just moments ago, right behind you, US officials entered that room. What can we expect from day 2?
That's right. Moments ago, they entered the room. The Chinese delegation, the U.S. delegation, we're about 20 minutes into day 2 of these talks, Jonathan. I quickly caught up with Commerce Secretary Howard Lutnick. Remember, he's in addition to these talks. He was not present in Geneva, and he said the talks are going well, and he expected the talks to happen all day long. We were outside Lancaster House till about 8:30 local time yesterday evening. They had food brought in. The talks went all day, more than 6 hours, but they still left without an agreement, and that is why we are here at day 2. There is a timeline, a time frame that they need to wrap up these talks, though, because Secretary Bessent is due on Capitol Hill tomorrow in Washington, D.C. to testify before the House Ways and Means Committee in Congress. So he has really a clock that he needs to hit today. We're still looking for the parameters of this deal. The president yesterday, speaking to our very own Tyler Kendall at the White House, saying that basically leaving it open-ended. Not sure yet exactly how far he's going to go on easing some of those export controls. Our understanding is some of those restrictions are more of the new restrictions. Things like chip design software, nuclear materials, jet engine parts, not going to the line of potentially a red line for the United States of the H20 NVIDIA chips that obviously Beijing, Jonathan, and Danny are still trying to get their hands on.
Anne-Marie, just build on some of this. Progress. Define the word progress. Are we making progress relative to where we were last week, or making progress to where we were back a few weekends ago when we had talks in Geneva?
It's a great question. We need to put some context around that. We're making progress on where we were just a few weeks ago when Secretary Bessent said talks stalled. And then, of course, there was that phone call between President Xi and President Trump that really opened up the pathway to have these talks at Lancaster House in London between the two trading teams. There's progress from the stalling. We are really not progressing, though, from those talks in Geneva. When they come out with an agreement today, it's because both sides said they were each reneging on the deal and the terms that they understood that they set in Switzerland. And Jonathan, you brought something up at the start of the show that I think we need to continuously remind our audience, especially as they see whiplash when it comes to trade headlines day in and day out. Trump's first administration, the trade war started in 2018. We didn't get a purchasing agreement when it came to the Phase 1 deal till 2020. This is going to take a lot of time.
4Q 2026. Anne-Marie, thank you. Can you wait until 4Q 2026 to wrap this up?
I cannot wait. These markets, I don't think, can wait. Maybe we just get more, maybe it'll be a good thing. Maybe we just get more days like Monday and Tuesday, and we can all relax and pull away from our terminals for a little bit.
I'll take a few of them, that's for sure. We'll have more from Anne-Marie later on in the program this morning. She'll be standing close. Here's the view on Wall Street this morning. Sitara Sundar of JP Morgan Private Bank writing the following. We believe U.S. equities are poised to make new highs over the next 12 months, driven by strong corporate earnings. Sitara joins us now for more. Sitara, good morning.
Good morning.
Can those strong corporate earnings show up and show some resilience in the face of this immense policy volatility?
I think so. Look, I think, one, the latest earnings season has been extremely resilient. I think we've seen strong earnings growth, and we've seen breadth in that earnings growth. Obviously, tech leading the earnings higher, but we've seen breadth, and we've seen strong earnings growth across the board. Now, what we're dealing with, and so far in this current market environment, is this push and pull and tug of war between the bulls and the bears. It feels like the tale of two cities. If I can take us back to English Lit in high school, where on the bullish side, economic growth has been resilient and earnings growth has been resilient. And we believe that the more these negotiations take place and the longer that the implementation starts to get shifted even further out, it actually gives companies a lot more time to adjust their supply chains. I think we need to remember, too, that a lot has happened in post-COVID. A lot of companies, post the 2018 trade war and then also post-COVID, a lot of companies have already started to reorganize their supply chains. So that resilience is there. And the biggest thing that we try to tell our clients, though, is that at the end of the day, when we think about equity markets, they ride on earnings growth over the long run. So we need to see that durability, but we're really leaning into pockets of the market across public and private markets on portfolio resilience, which is a term I know that is used ad nauseum, and I'll admit that. However, we also impress upon clients that portfolio resilience means more than just downside protection and leaning into less correlated return streams. In the private markets, that means things like infrastructure or even areas within the relative value and macro hedge fund space. But even in the public equity markets, we're talking a lot about global diversification. That's not just going to give you downside protection given the volatility that we're seeing so far this year, but it's also going to give you that potential for upside given the incremental news and positive earnings growth that we're seeing within Europe and Japan as well.
Before we get to that, let's take another beat on the earnings story.
Yes.
This is the bear case. The bear case is the data and the earnings have been flattered by a pull forward. This summer we get the bill. Do you push back against that?
I do. Look, I think that there is obviously something to say about a lot of inventory and orders being pulled forward. But when we think about earnings growth over the next 12 months, we're still expecting mid-single-digit earnings growth. I think when you look at the S&P 500, one of the things that we need to remember is that the markets and the economy are not always going to be the same thing. And when we look at that underlying earnings growth, about half of the S&P 500 is related to tech and tech-oriented areas. And the capital spending that we're seeing within artificial intelligence, no one is stopping, right? We're seeing all of these hyperscalers still putting in a lot of investment within CapEx. So we think that's going to shore up earnings on that front. But then also on the opposite side, those more value-oriented sectors, areas like financials and areas like banks, we're actually seeing pretty incremental progress on that front. And then trade policy and policy in general from this administration, there's two sides to that coin. There's obviously the trade policy uncertainty that we're seeing so far this year. However, the pro-business deregulation agenda is something that we still expect to see. And in the second half of the year, we actually expect to start to see those green shoots, which should shore up earnings as well.
What is the bar, especially what we get out of today's talks, that allows the market to keep rallying? Is it a very low bar or is it a high one, given we're only 2.3% away from all-time highs?
Look, I think that the bar is always high for us when we're thinking about where to put our clients' incremental dollar to work. What we're really trying to do is separate what's happening at the index level and focus on those bottoms-up opportunities. And what we are seeing is that we are very close to all-time highs, but a lot of that has still been driven by a handful of names. If you look at opportunities under the hood, let's just take even a step back. Forget what's happened so far this year. Over the past couple of years, a majority of the returns that have happened within the S&P 500 and even global equity markets has still been concentrated in the mega cap tech players. And we expect to see breadth. Now, the rising tide is not going to lift all boats. We need to be able to focus on those quality earnings compounders across, again, public and private markets, because when we think about the next cycle and the next decade, higher rates, likely going to be higher inflation, even if it comes down a little bit. So what that means is that we need to be able to find those companies with solid balance sheets that are able to weather the storm of a higher rate and higher inflationary environment.
Well, what we heard this earnings season, it was really only a handful of companies that really talked in earnest about raising prices. You had Hermes, but of course not everyone's buying a Birkin, so maybe who really cares about that? Ford talked about it. Walmart tried to talk about it, and it was shot down. Were you surprised you didn't hear more discussion of prices going higher for corporate America?
Look, I think that it's a very delicate balance in terms of forward-looking guidance, and I wasn't surprised to see that not as many companies were trying to paint what the roadmap was going to look like over the next 12 months, not just because of inflation, but there's a lot of uncertainty in the environment right now. But when we think about where to put the next dollar to work, we do think that there's going to be pass-through, that companies are going to be able to pass through a lot of the price increases down to the consumer. So what that means from our perspective is two things. One, how resilient is the consumer and therefore how resilient is the economy? We're still seeing consumer spending level strong. It's something that we're monitoring very closely. But then two, to this idea of what's going to end up happening on the inflationary front, we do believe that there's going to be volatility within inflation. So what does that mean when we think about client portfolios? We are looking for areas on that portfolio resilience point where you can even generate income that is inflation protected. I think that's probably the biggest point that I can probably make. Core fixed income obviously has a place within client portfolios. It always has. It provides that durability and that downside protection. However, we've also been incrementally talking to clients about infrastructure, where you are supported when you think about these long-term returns, long-term contracts, contractual cash flows, but cash flows that have inflation escalators embedded within them, where that yield and that income that you get ends up keeping up with inflation so that you actually have that durability.
Just a final word on that. I think you're making a really important point. A lot of people are having the same conversation. If things go wrong, will bonds bring me comfort, or do I need to look somewhere else? Are you pushing people to somewhere else?
We are pushing people to areas of the market that are going to complement the exposure that you have. Core fixed income is always going to have a place. However, when we think about the market environment moving forward, the 60-40 is likely not going to be enough. You're going to need other areas of the market that are going to be able to shore up that portfolio resilience. Infrastructure is one of those places.
Sitara, enjoyed this. It's good to catch up. Thanks for being here.
Thank
you. Sitara Sundown there of JP Morgan Private Bank. If you are just joining us, welcome to the program. Equity futures just about unchanged on the S&P 500. It's day 2 of trade talks in London between the US and China. Anne-Marie standing by over in the British capital. We'll catch up with her a little bit later. For an update on stories elsewhere with your Bloomberg brief, here's Yahara Arnott. Hey, Yahara.
Hi, John. The Trump administration has deployed 700 Marines to Los Angeles to respond to
anti-deportation protests. Meanwhile, the state of California is suing to try to stop the deployments. President Trump backed comments from border czar Tom Homan that California Governor Gavin Newsom could be arrested if he interferes with the response. Meanwhile, as you were just discussing with Anne-Marie, trade negotiations between the U.S. and China are continuing for a second day in London. The U.S. signaled a willingness to remove restrictions on some tech exports in exchange for assurances that China will ease limits on rare earth shipments. Treasury Secretary Scott Bessent said they had a good meeting yesterday, and Commerce Secretary Howard Lutnick called the talks fruitful. And Apple shares ended lower yesterday as AI took a back seat at its Worldwide Developers Conference. Instead, it focused on a new software redesign called Liquid Glass. Apple did introduce some AI-powered features, including an expanded relationship with OpenAI, which will help it match features already offered by Samsung and Google. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, nothing good comes easy.
We are doing well with China. China's not easy. China has been ripping off the United States for many years. Nobody charged them 10 cents. No president had the courage to charge China for whatever reason.
In just a moment, we'll catch up with the former Trump trade official, Kate Kalukowicz. She joins us next. Plus, we'll catch up with Bloomberg's Tyler Kendall, who was in the room with the president.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
Back-to-back gains on the S&P 500, looking to make it another day of gains. We're positive here by 0.1% on the S&P, on the Nasdaq up by 0.15. Under surveillance this morning, nothing good comes easy.
We are doing well with China. China's not easy.
Did you give your negotiators any sort of
We're
limitation?
going to see. Look, China has been ripping off the United States for many years. Nobody charged them 10 cents. No president had the courage to charge China for whatever reason. They didn't want to do it.
So here's the latest this morning. Trade talks between the US and China back on in London for day two. The Commerce Secretary Howard Lutnick telling Anne-Marie just moments ago he expects talks to go all day today after saying they were fruitful yesterday. Joining us now is Bloomberg's Tyler Kendall, who was in the room with the president yesterday afternoon. Tyler, what was your takeaway from that particular exchange?
Yeah, hey, John, good morning. Well, it's clear that the White House is trying to thread the needle here. We have to keep in mind that one of those preconditions for these talks to even happen was that the U.S. was going to temper its rhetoric to be more respectful when it comes to China. But it's clear that President Trump doesn't want to give up his leverage and that they are trying to pressure China when it does come to these discussions, even as officials on the ground do express optimism moving forward. And President Trump told me directly that ultimately China is, quote, not easy to negotiate with. And when I pressed him on if he gave his negotiators any sort of limitations on export controls, which is really what these talks at the moment are centered around, as you heard, he was pretty non-committal, but he also didn't rule anything out. Now, our reporting does indicate that the U.S. has signaled a willingness to remove restrictions on some tech exports in exchange for assurances that China will, of course, speed up its export licenses for rare earth materials. People familiar do tell us that the Trump administration is prepared to remove measures targeting chip design software, jet engine parts, also some nuclear materials. These really are where we saw these new restrictions go into place in recent weeks when it comes to the Trump administration. And John, at the moment, there is a lot of focus on the Commerce Secretary being there on the ground in London. But we should also point out that last week we had quite the split screen here in Washington. The same day that President Trump held his phone call with Chinese President Xi Jinping, you also had Commerce Secretary Howard Lutnick on Capitol Hill testifying to lawmakers that he actually thinks there needs to be stronger enforcement when it comes to export controls against China. So there's still a lot of issues that need to be worked out here.
Tyler Kendall with the latest in Washington. Tyler, thank you. More from Tyler in the next hour. The National Economic Council Director, Kevin Hassett, made this sound quite simple yesterday, straightforward. This will be short. Ultimately, on our side, we'll drop some tech restrictions. On their side, they'll ease some shipments of rare earths.
That's Kevin Hassett, but it might be a different question as to what exactly is happening in the room. And given it seems that these restrictions were put on recently, it seems like the Trump administration has come in with some extra pressure that they want to put on. So just how easily are they going to be willing to relinquish that control when China holds a really big chip when it comes to rare earth metals?
To have that conversation, joining us now is the former Trump trade official, Kate Kalukowicz. Kate, welcome back to the program. I want to lean on your experience and how you define progress in this round of talks.
Well, progress would be an outcome, as opposed to just officials that are not in London commenting on how things are going.
So an outcome, what outcome might we hope for, Kate? What might we get out of this?
Well, this is the question around which outcome both sides are hoping to achieve here. I mean, if we are really just trying to get a reaffirmation of what was already agreed to in Geneva, these should be relatively short meetings. The fact that they're dragging on longer than anticipated indicates to me that one side is perhaps dragging its feet, thinking it can get something more than just the Geneva deal.
We also are in a moment where China has been tightening its rare earth exports, not just for America, but for all countries. In order to reach some type of deal, Kate, does China need to walk away with something that the U.S. can offer that it desperately needs? Just how much does the U.S. side need to move?
Well, look, I think that the U.S. desperately needs the rare earths. That's the outcome that President Trump has sent his negotiators to get here. China, as you point out, has restricted these minerals to other nations too, but they're negotiating in parallel with the Europeans and others alongside the United States. So this isn't the only game in town. That said, the United States is under the impression that as an outcome of the Geneva talks, China agreed to release the rare earths. And so this is a bit of a he said, she said discussion. Now, what the United States has to do to get China to release these minerals remains a bit unclear. The Americans, I believe, placed these new restrictions on Chinese students in the United States as a way to get the attention of the Chinese and perhaps feel that an easing of visa restrictions will be sufficient. Though China, of course, has signaled it wants more than just the visas. It wants restrictions lifted on certain AI export controls as well.
Okay, last time around in the president's first term, it took 18 months to achieve a phase one deal. And at the epicenter of that phase one deal were purchase agreements. And I wonder, Kate, from your perspective, from your vantage point, whether you think it's different this time. The ultimate end goal has changed and maybe it's going to be harder.
It's a terrific question, and I think we all remain a bit unclear about what the end goal is this time around. Now, you remember in the first Trump administration, we had a fairly lengthy investigation and public report articulating a myriad of concerns related to China's unfair trade practices, relating to forced technology transfer, IP theft, unfair subsidies. In this case, we hear from the president from time to time issues he'd like to address in China, but it's not nearly as clear. So an outcome could take as long as 18 months or longer, particularly if the ground keeps shifting as it does.
Well, let's just sit on that for a beat longer. I'm confused now. When they were making the argument they wanted to rebalance global trade and push China to drop its walls, that made perfect sense. I remember the NEC director, I'm sure you do too, Larry Kudlow, used to talk about reciprocity. But since the Biden administration, the focus appeared to be more on national security and strategic decoupling. Do you think it's more of the latter and no longer the former anymore, driving things down in Washington?
Yeah, I think that's true. I think that the shift in tone has frankly encompassed all of Washington. Both Democrats and Republicans, I think, have acknowledged this notion of strategic and economic competition with China and the need to confront the growth in critical sectors. So some of it, of course, will still be about access. President Trump has spoken quite clearly that he wants American companies to have access to the Chinese market. So I do think we will still see a focus on certain purchase commitments, certain access restrictions being lifted. But this is a much broader competition now. And I think in some ways, President Trump has brought the fight home, where we see, new measures impacting domestic manufacturing in the very critical sectors China dominates now. So as opposed to a tariff-heavy war that we saw the first time around, I think both sides are going to try these supply chain restrictions to stop the other from advancing in this long-term economic competition.
Kate, appreciate your take as always. Kate Kalukowicz there, the former Trump trade official. What's progress? Progress is an outcome. We'll see if we get an outcome later on this afternoon.
And hopefully it's an outcome that sticks. We had progress in Geneva, and here we are again having to have these conversations. So progress is fluid, let's say.
Equity futures right now positive by a tenth of 1%, following back-to-back gains on the S&P 500. In just a moment, we'll catch up with Isabel Mateo-Salago of BNP Paribas. Looking forward to this week's inflation data. CPI tomorrow, PPI coming the day after. Live from New York City this morning. Good morning.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appear, immediately I asked whole corporations study how will you bring generative AI to their job.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Quiet week so far. It gets busier. Tomorrow, CPI. The day after that, PPI. A couple of debt auctions in focus as well. But so far, so good. Equity futures on the S&P 500 just about unchanged. On the NASDAQ 100, positive by close to 1/10%, with 3 hours until the cash open. Let's get you some morning movers with Yahara Anand. Hey, Yahara.
Hi, John. We start with Novo Nordisk up 3% here in the pre-market on an FT report that activist hedge fund Parvis Asset Management is building a stake in the company. And they report that Parvis wants to say in who the next CEO will be, as it faces rising pressures in the booming weight loss drug market. But not booming has been this stock, which has been cut in half in the last year. Meanwhile, next up we have Taiwan Semiconductor. Those shares are up 1.6%. It posted a 40% jump in May revenue as companies rush to stockpile its chips before U.S. tariff relief expires in July. The world's top chip maker, supplier to Apple and Nvidia, brought in over $10 billion last month. And while that was down from April, TSMC says AI demand remains hot and it still outstrips supply. And we end with McDonald's here. Those shares are falling nearly 1.5% after it was hit with another analyst downgrade, this time from Redburn. Yesterday, it was Morgan Stanley, which downgraded the stock, saying that there are more headwinds ahead for its lower income diners. And then there was Loop Capital, which flagged that people were complaining about its McCrispy chicken strips, saying they don't have as much breading and that they're smaller. So they also downgraded the stock. I could not confirm that, but happy to do market research. John?
Yahara, thank you. There's a couple of words that scare me. Food innovation. I don't want innovation on my food.
No,
I don't know about you.
What is that like? I don't want new chemicals, and so I just leave the science out of it. Just give me real chicken, and I'm happy.
You mentioned a wrap this morning I've never heard of when you were talking about McDonald's on the program.
Yeah. Oh, a katsu wrap.
Right, a katsu wrap.
Yeah, which
in McDonald's.
I mean, it sounds delicious, but you
That's a
wouldn't
London
really.
thing.
Yeah, would you trust London McDonald's to give you a chicken katsu wrap? I'm like, maybe in Japan you go get that, but I don't know.
Probably not. Okay, we'll leave that one there. On our radar this morning, our top story. A second day of trade talks between the US and China underway in London. The US signaled a willingness to remove restrictions on some tech exports. Officials still pushing China to ease limits on shipments of rare earths.
I think it's important just to note who has the upper hand and what China is specifically doing with their rare earths. Because they're not just putting restrictions on the US. This is a global effort that they are doing. You get the sense that China realizes how crucial rare earths are and are trying to give it long-lasting leverage by really controlling the shipments, who gets it, when they get it. And for the US, you have an auto manufacturing industry that's so dependent on it. It is a rare bit of leverage that China has that it can really flex. So just how much does the US need to cave in these talks to really accommodate that?
I don't want to predict the outcome of this. I don't think you want to either. But yesterday it was framed by the NEC director, Kevin Hassett, as quite straightforward. Easy, sure. The fact it's spilled into a second day probably speaks to the idea that maybe this is a little bit more difficult to get done.
And not only has it spilled into a second day, but the Commerce Secretary, Howard Lutnick, Lutnick told Anne-Marie earlier this morning he expects it to go all day, too. They were there until 8 p.m. last night. He expects it to go that long at this time. And remember, it's not even this that they have to figure out. They have to figure out all of China tariffs, not just rare earth metals. They have to figure out all the reciprocal tariffs. If this one issue on itself is taking this much time, it shows just what a long road ahead they have.
The president is focused on other things, including this, the White House sending 700 Marines to Los Angeles in response to the anti-deportation protests. California Governor Gavin Newsom suing the administration for its response, and the president saying Newsom may be arrested if he interferes.
I have to say, I think this is likely the fight that Trump is more happy to take on than, say, an Elon Musk fight. Trump's approval ratings are very strong on immigration. 54% in a CBS poll going into this weekend saw him more favorable on his deportation efforts. This is something his voter base likes to see. And let's make no mistake, I think it's telling that this happened in a deep blue state, that this happened in a place that's really concerned about immigration, where you can get these images. Trump, more than anyone else, knows the power of these images and what that likely does to get his base excited about the immigration actions
I could not agree with you more. Really couldn't. The president seems to be much more comfortable with this as a topic than, say, trade. And I think it takes some heat out of officials, or at least off officials, down in Washington on the following. House Speaker Mike Johnson pressuring Senate Republicans to preserve a deal raising the SOL cap to $40,000, pushing back on President Trump's willingness to scale back the write-off. All of a sudden, this conversation is not the front page. It's not the headline. It's on the back pages. The focus is on Los Angeles.
Right, because this just underscores dysfunction. But let's be honest, all of this looks to an international audience as something of instability, especially images in Los Angeles, dysfunction in D.C. It really underscores this narrative. Because what do you get if you have the Senate pushing back? It needs to go back to the House, where you have such a thin majority. In the House, you have people who care about SALT. In the Senate, you don't really have that constituency as much for Senate Republicans. So it's this back and forth and just underscores how difficult reconciliation is, even before a midterms where you might get changes to the makeup of the House and Senate.
Have we still got a self-imposed July 4th deadline?
Yeah, apparently so,
okay.
And the clock is ticking down very quickly.
They themselves have called it aspirational. We'll see if they can get it done. Looking ahead to some economic data this week. CPI tomorrow, PPI the day after. Isabel Mateos Ilago of BNP Paribas bracing for tariffs to make their mark, saying the following: the bulk of the price impact from tariffs is still ahead of us and likely to come in full force through the summer. Isabel joins us now for more. Isabel, welcome to the program. Good morning.
Good morning.
Where do you see it hitting hardest? When you think about the sources of inflation, where are you expecting this to show up?
Well, we've seen some sectoral tariffs being particularly high, so steel being a key example, automobiles. These are the high tariffs. These are the 25, 50%, but obviously it's a small part of the total imports. And then the rest is 10%. This is more likely to see corporates trying to be a bit patient in figuring out how much of it do they want to try and absorb through cost reductions or just absorbing the hit on their earnings versus passing it on to their consumers. So it will be, I think we will see the impact first in small parts of the CPI, but it will broaden out over time. And I think that's why so far the numbers haven't shown, anything massive, but it's going to creep through, I think, fairly gradually.
In the immediate aftermath of the pandemic, coming out of the pandemic, if we had this trade war then, we saw consumer balance sheets which were very strong and a labour market which was incredibly tight. And I think a lot of people would have been far more worried about second-round effects and inflation getting out of control. How different are things now sitting here in 25?
It is quite different. You're right to point that out. The consumer demand is not endlessly elastic. As you say, the labour market is still strong, but is clearly moderating, cooling down. And I think this is what you're hearing in corporate communications when they talk about their strategy to deal with these tariffs is they're going to be a little careful because they don't want to lose market share. And in fact, some are aggressively pursuing market share as part of this environment. And so I think that's why we're going to see a very gradual pass-through and also more emphasis on cost control, maybe additional automation to control the cost pressure. So it's going to be really interesting to see how this pans out. But I think that doesn't mean we're off the hook in terms of risk of second round effect. That's still very much part of the picture. It's less prevalent than perhaps right after the pandemic, but it's something we need to keep in mind. And then the last point I would add, and this brings us back to the rare earth conversation, is where you could really see a very sharp price impact is if you get supply chains breakdowns because you have an essential component that is missing, and all of a sudden production stops, and that's when you can see really big spikes. And I think that's why we've seen intense focus on this in the U.S.-China talks. Not so much on the tariffs, but on making sure that these rare earths keeps flowing where they need to flow, so that you don't have supply chains breaking down.
The other thing that's very different from COVID and the volatility we had then was rates were taken down to zero. Rates are higher this time, and you have a Fed who's been very unwilling to suggest that we would have any cuts in force because of the unknowingness. How much pressure does that mean there are for corporate balance sheets right now? We haven't really seen defaults tick up too much, but if this period continues on, could that change?
For sure. For sure. But I think the primary concern for the Fed right now is, keeping inflation expectations as anchored as they can be. You can debate, are they fully unanchored or are they, but they certainly look a little wobbly. When inflation expectations bounce around based on, headline news, it's telling you something. So I think right now this is the number one concern for the Fed. It's not the health of corporate balance sheets. But of course, they also don't want to overdo it. And I'm sure they will want to cut as soon as they're reassured that we're not going to see second round effects, but they have a very tight path to walk.
Well, inflation expectations bouncing around, I'm assuming you're in some part referring to what we got yesterday from the New York Fed. A round trip in inflation expectations, they come down to undo the tick up you had higher in April. Do you just discount that? What do you do with something like that?
Well, no, you just notice the volatility of these inflation expectations, which is by definition means they're not anchored, and they may just bounce back up if we see, if at the end of the 90-day truce we see tariffs going back up, or the talks in London between US and China don't go the right way, and that is not a healthy situation. And in that situation, the central bank has to be really putting a premium on the credibility of its commitment to keeping inflation, bringing it back to targets.
Andrew Honhorst of Citi was in your seat yesterday, and he said that the Federal Reserve will have to take the summer off, that maybe they start cutting interest rates in September, but basically for the rest of the summer, goodbye, let's see how this shakes out. Is that your view on things too?
At least, and in fact, I think September looks very early. I'm very doubtful we'll have any greater clarity in September. And again, they really don't have any reason to take a chance one way or the other. We need to see how quickly these tariffs are getting passed through or not. We need to see where the tariff rates land. We still don't know that. If we're at 10%, it's a very different story than if we're back at, it'll be anywhere between 20 and 40%, depending on countries. I think it's very difficult to see the Fed moving before the end of the year.
If unemployment gets to 4.5, 4.6, 4.7, and we still haven't resolved the trade story, how interesting are things then for the Fed?
Then it gets very hairy, and I wouldn't want to be in their shoes. But absolutely, that's what they're going to be looking at. But remember, the labor market is having a dynamics of its own because of, we saw in the last numbers, participation rate coming down, immigration, falling, and so you have a shrinking workforce, or at least a workforce that isn't growing as fast as it used to. And so you can have a much more tepid pace of jobs creation and the unemployment rate staying kind of where it is, which is not good news for the economy at large. It's not good news for GDP growth, but for the Fed, it means that it means a labor market that doesn't give it the weakness that it needs to cut.
I heard this a few times. The Fed needs to sit this one out for the summer and maybe even beyond.
I think there's probably an acknowledgement that this also isn't the Fed's battle. It's not under the control of monetary policy right now. What's happening in the world is a political economy. It's one driven by fiscal policy. So maybe just for that very reason, there's sort of a bias from the Fed to say, let's not move in here, because if we get a recession, it's not our fault.
Isabel, it's good to see you. Thanks for dropping by. Thanks for your time. Isabel Mateo-Salaga there of BNP Paribas. For the Federal Reserve, focused just as much on the CPI data of Wednesday as they are on the trade talks in London. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Yahara. Hey, Yahara.
Hi, John. The UN nuclear watchdog says Iran's stockpile of enriched uranium cannot be ignored. The warning comes as the International Atomic Energy Agency's Board of Governors meets this week in Vienna. It reported last month that Iran's inventory of close to weapons-grade uranium is at record levels, growing by 50% in the last 3 months. Meanwhile, U.S. Health Secretary Robert F. Kennedy Jr. dismissed all 17 members of a key federal vaccine advisory panel, accusing them of conflicts of interest. Before joining the Trump administration, RFK Jr. was known as a vocal critic of the committee, which advises the director of the CDC and helps shape national public health guidelines. And Meta CEO Mark Zuckerberg is creating a new AI superintelligence team. Sources telling us here at Bloomberg that Zuckerberg aims to hire around 50 people for the new group. He believes Meta can beat other tech companies in achieving what's known as artificial general intelligence, or AGI, the idea that machines can perform as well as humans at many tasks. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, Apple is not at the party.
The main thing that everybody cares about is our Apple devices are dumb. Apple isn't even at this party. So what we want to see is Apple taking aggressive steps to redo their entire operating system around AI.
Did we get any of those aggressive steps yesterday? We'll catch up with Michael Eng of Goldman Sachs in just a moment. From New York, this is Bloomberg.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Live from New York City, welcome back to the program. Just a flavour, a snapshot of the price action for you this morning. Good morning to you. Futures positive by 0.1% on the S&P, on the Nasdaq 100 up by 0.07. No drama there whatsoever. Under surveillance this morning, Apple is not at the party.
There's actually no real big change that was announced in this event. The main thing that everybody cares about is our Apple devices are dumb. Apple isn't even at this party. So what we want to see is Apple taking aggressive steps to redo their entire operating system around AI versus these sort of incremental attempts at making Siri better, and we just didn't get that.
So here's the latest this morning. Apple failing to impress investors at its Worldwide Developers Conference, with AI taking a backseat to a software redesign. Michael Eng of Goldman Sachs has a buy rating and 253 price target on shares of Apple. Mike joins us now for more. Mike, good morning.
Thank you for having me.
How disappointed were you yesterday? What did we hear versus what you wanted to hear?
I wasn't very disappointed at all. I think investor expectations for WWDC 25 were very low, and I think that Apple met that low bar. Apple opened up the session by conceding that the personal features that would be coming to Siri would, be delayed to the coming year, and that was largely as expected. And we got several quality of life improvements. There was a new design interface called Liquid Glass. There were some Apple Intelligence features embedded into several new features across the operating system, like live translation, a workout buddy, things of that nature. But I think they delivered some incremental improvements and inline expectations, albeit low ones, going into the event.
I think a lot of people would agree, including you, based on what I've read in your note, that this isn't sufficient to really drive massive demand into Apple iPhones. But do you see anything happening outside of Apple that would erode demand for Apple iPhones?
Yeah, I think you hit the nail on the head in the sense that investors care about Apple Intelligence to the extent that it helps to drive iPhone demand and demand for other products within the Apple suite of products. And while Apple Intelligence is an important software demand driver, there are other things as well that I think may be underappreciated right now. Some of the things that I'm excited about are some of the upcoming form factor changes. Apple's last iPhone form factor change was back in 2017 with the iPhone 10 when they got rid of the home screen button. And over the next several years, I think we'll see some very meaningful ones. This year with the slim version of the iPhone, next year the foldable, the year after that in 2027, the 20th anniversary phone where we may get an all-glass enclosure and a new design of the exterior.
Are those enough in the absence of AI to drive new demand cycles?
I think they are. I think that form factor changes are the most meaningful demand driver for consumers today. And outside of that, I think there are other things that should be helpful in helping to shorten the replacement cycle and driving demand. So in the U.S., which is just over a third of Apple's revenue, I think the rising competition among wireless carriers is helping. I just upgraded my iPhone in the last week, and I got it for free, lowered my monthly bill, and I think you're seeing more promotional activity coming out from Verizon, AT&T, and T-Mobile after those carriers enjoyed a very long period of benign competition after the T-Mobile Sprint merger.
Is there a point at which that changes? Kind of to John's point in his question, when you look at Android making really far advances where I can take a photo and I can completely redesign it with AI, is there a point where that becomes attractive enough, if Apple hasn't caught up, that users do start switching?
Absolutely. I think it's a real threat. I think at some point, some of these new software features, these AI features, could be a point of differentiation for Android and other devices. But I think at this stage, we haven't really seen that market share loss yet. The iPhone install base continues to grow every single quarter, year after year. And I think that that's the most underappreciated asset that Apple has, that 1.2 billion iPhone install base users and the over 2.3 billion, 2.4 billion across all devices.
Would it help if they stopped talking about Genmojis?
I'm not the biggest fan of Genmoji, but I'm probably not in the age demographic.
I have to say that just for investors and for analysts, it just seems frustrating. It feels like amateur hour when they start talking about combining emojis and making Genmojis. I just think in this moment, at this time, when we're looking for that serious incremental improvement in the software and what we can do, the usability of the phone, and they start talking about combining emojis on the screen, they kind of lose me pretty quickly.
I don't think there's a killer app for that's the same for everybody. I think everybody wants to use AI in their own way. So, for example, I thought the live translation tools that they announced yesterday were going to be really attractive to the vast majority of the user base. And I personally am excited about improvements to things like writing tools to help draft responses to emails and text messages beyond what's available today.
I wish they had live translation when my Italian grandparents were still around. They would have loved that. That would have been absolutely phenomenal.
You mean they wouldn't have loved you transforming yourself into a unicorn Genmoji talking to them?
No, I don't think they've been too interested in that. But I think the live translation is interesting because other people are already doing it. So it's catch up. Is there anything other people are doing, to Danny's point, anything other people are doing that Apple hasn't met just yet and needs to do?
I mean, we've seen some interesting demos of a more personal, high-powered virtual assistant coming out from other developers and applications. And, you know, I think Siri, for the most part, hasn't delivered against that promise yet. With that being said, this Siri with more personal features and better on-screen awareness, that'll come out in the coming year. And I think those new software features will be rolled out in tandem with some of those form factor changes that are coming out in the next couple of years. So I think you've got Apple rolling out those better powered AI features along with new form factor changes for the iPhone that I think will result in a really good shortening of the replacement cycle in iPhone demand.
What about the hardware? When this VR headset came out, there was so much hype around it. You couldn't even try the things on without getting onto a wait list. It really feels like it's fallen by the wayside. Are we going to look back at that period and say it was a boondoggle, it was too soon for Apple to try to release something like that into the market?
Yeah, the numbers for the Vision Pro have certainly been fairly low and immaterial in the grand scheme of things. With that being said, I think it's a recognition that we have all this new technology in VR, AR, in AI, and perhaps there can be a new consumer product that's developed to fully utilize and embrace that new technology. And Vision Pro is an excellent example of that, as is you know, what's potentially coming out of OpenAI and I/O. So I think it's to be determined. You know, I think adoption of a consumer product like that at scale will certainly take some time. And I actually applaud Apple for being on the bleeding edge of innovation on the VR AR side, with the recognition that commercially it probably hasn't been as successful as investors would have liked.
Mike, in the time we have left, the focus at the moment for markets at least is on the trade talks in London. What are your base case assumptions tonight, underlying assumptions on how this shakes out between Tim Cook and President Donald Trump with regards to tariffs on iPhones?
So I don't have a magic 8-ball to figure that one out.
Neither do we.
But you know, what I would recognize is that Apple's contemplated a level of tariffs in its current financial guidance for the June quarter, really assuming the current state of things, which is the 20% IEEPA, so-called fentanyl tariffs, and the upcoming reciprocal tariffs. And you know, Apple's done a very good job of managing the supply chain and managing the tariff exposure that it has for iPhone and the other devices within the Apple suite. And that includes diversifying into India, where you know, the majority of U.S. iPhone sales coming in the upcoming quarter will have a India product country of origin.
Which is something the president seems to be unhappy about. Mike, good to catch up. Appreciate your time. Michael Eng there of Goldman Sachs. Live from New York, the second hour of Bloomberg Surveillance is up next.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars.
Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
And Davos, you were asking a question of President Trump, and he
didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, you know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area that comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
There's nothing simple about the U.S.-China relationship that have a number of challenges.
Both countries have identified the other as their most significant long-term strategic challenge. That's why both sides are now at the table.
The president has many, many goals when it comes to economic relationships.
The reality is that tariffs are here to stay. The only thing we're debating is what's the magnitude and in what form is it actually unleashed onto markets.
Good agreement, neither side's going to get everything they want. So they're going to have to give in on some things. What are the red lines?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning, good morning to all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this on the S&P 500. Equity futures just about positive, following back-to-back gains on the S&P. We're positive by not even 1/10%. Likewise on the NASDAQ 100, a quiet start to the week, we'll take it. It gets busier as this week grows older. CPI tomorrow, PPI the day after that, and two very important debt auctions coming up later in the week.
It just underscores that sentiment has improved so much, but there are so many catalysts that could change that. When you have a New York Fed consumer inflation expectations survey come back and inflation expectations are back down, you have the sell side upgrading left and right what they see as their expectation, the S&P 500 2.3% away from all-time highs, and yet we are in London, day 2, and no agreement has been reached on rare earths and tech exports. It is such a long road ahead, but already there's so much optimism priced into risk assets.
Let's talk about that optimism. Lisa Shannon of Morgan Stanley said this is a rally looking for a credible narrative. She doesn't think there is one. We've had a rally of more than 20% off the April low. What's the narrative to drive us a step higher from here through the summer?
Every day it's something different. The latest one that this market seems to wraps its hands around is tech. The latest flows, Citi pointing this out, it's basically all going into tech. That all of a sudden we're back in this environment where if you're unsure if CapEx is going to continue, if things look icy, the one place that is spending and spending massively, it is the technology. It is the hyperscalers sending billions after billions trying to invest. So it is a market that keeps coalescing around big tech.
It's like JP Morgan said, it's the twin pain trade, an equity market that keeps grinding higher and narrower leadership coming out of, Danny said it, coming out of tech. Equity futures this morning, barely positive. Let's set you up for the hour. In just a moment, we'll catch up with Matt Miskin of Manulife John Hancock Investments as stocks post a two-day winning streak. Henrietta Trey's of Veda Partners with US-China trade talks continuing. And David Tinsley of the Bank of America Institute on the state of consumer spending. We begin this hour with our top story, a second day of trade talks in London.
We are doing well with China. China's not easy. We want to open up China, and if we don't open up China, maybe we won't do anything, but we want to open up China. It'll be a great thing for China, a great thing for the rest of the world.
On the ground over the last couple of days, Bloomberg's Anne-Marie out of London. Anne-Marie, day one, and we were told it was fruitful. Talks are going well. What are we looking for from day two?
We're looking for day two then to come out with some sort of agreement and for acknowledgement that each side potentially is going to really get back to what they agreed upon, Jonathan, 4 weeks ago in Geneva, because Washington and Beijing basically accusing each other of reneging of what they agreed upon on those talks in Switzerland. Day two of the meeting, I will say they're just a little bit over an hour sitting down, the Chinese delegation and the U.S. delegation, after more than 6 hours at the table yesterday. I should note, I don't know if this is a barometer, but food delivery was just brought in once again from the famed Israeli-British chef Otto Lengi, brought in for day two. Potentially, they are eating now and having these discussions. But we have to remember and remind our audience, this can only be the second and final day, at least, of the London talks, because Treasury Secretary Scott Bessent is on Capitol Hill tomorrow, and he's not going to miss his hearing before the House Ways and Means Committee. So they are really at the crunch time now. What we are expecting is potentially easing of some export controls, the more recent ones when it comes to the U.S. side. And then what they want to see out of Beijing is an advanced pace of getting their hands on the rare earths and magnets that Beijing basically has a complete control of, with 70% of the market that China has control over.
If Otto Lengi can't bring people together, I don't know what can, Anne-Marie. But if we get some sort of agreement coming through from here, do we understand what happens next? This is just on rare earth metals and tech exports and imports. What after this, Anne-Marie?
It's a great question, because these are the two real choke points and red lines, especially for the United States. If they are willing to give in on some export controls, maybe some of the more recent parts, some nuclear material, some chemical materials, jet engine parts, what happens when China says we need more? We want to get access once again back to those NVIDIA chips that were made to be export compliant under the Biden administration, those H20 chips. And now you can see the complications of this dance. As Jonathan said earlier in the program, it's 2 steps forward, 1 step back. And yes, we are still just talking about two provisions of this deal, two policies of this deal. We're not even talking right now about the purchase agreement that Trump handled in his first administration, which we should remind our audience, that took 18 months. The trade war began in 2018, and we didn't get agreement till 2020.
It feels like we're working very hard just to stand still at the moment. Anne-Marie, with the latest in London, Otto Lengi getting free promotion, hey? I mean, I like the food. It's fantastic.
It's really good.
I'm not sure who's driving that order out of the U.S. delegation.
Yeah, you would think that they'd try to get something really American, maybe a McDonald's, throw something like that in there. Kind of interesting they're using a very British-Israeli type name to bring them food.
I'm going to say that's Secretary Bessent, but we'll try and find out. Let's get you the view on Wall Street this morning. Joining us now is Matt Miskin of Manulife John Hancock Investments. Matt, welcome to the program, sir. We won't talk about food. We'll talk about markets. Lisa Shannon of Morgan Stanley making the point that she believes this is a market looking for a credible narrative. Do you think there is one?
Earnings growth is the last bastion, the most important fundamental driver of stocks. In the U.S., earnings growth is there. We're seeing about 13, 14% earnings growth, but no one cares. Actually, U.S. quality stocks are the worst performers within the U.S. equity market and for the global market. Quality is on sale. The U.S. is on sale. The Sell America trade that we've seen for much of this year has made U.S. assets of the best value we're seeing per pound for the earnings growth you're getting. So earnings growth is the only thing that's going to get you there. In Europe, earnings are down on a year-over-year basis about 4%. In small caps, they're down. In mid caps, they're about flat. U.S. large cap quality stocks have the best earnings. The only problem is the markets don't seem to be paying attention to it.
How is that possible when we're just 2.3% away from all-time highs and still trading at multiples that look like something like 22 times for the S&P 500? Matt, where's the bargain here?
Yeah, no, it's more that the rally has been sentiment driven and multiple expansion. And we're in the part of the cycle where we're now seeing companies issue debt and preferred stocks to buy Bitcoin. So there is a lot of multiple expansion out there. It's been a global multiple expansion story, but it's interesting that the earnings growth companies are ones that haven't done as well this year. So they're up about 1% in terms of the quality factor this year. We actually think on a relative basis, the risk reward looks the best within equities. And then frankly, we're looking at the bond market and we're seeing a lot of income. The old narrative that it's a low interest rate world, it actually does apply for much of the world except the United States. And so we're really gearing towards income producing assets, providing income for clients, and using a multi-asset portfolio to get as much return potential we can.
So are we going to look at something like 4.9 on the 30-year yield, Matt, and say that is the buy of a lifetime, despite all the volatility it's seen?
You know, the last couple of years in bonds have created a ton of value. We basically had a bond bear market that was similar to that of 08 for stocks. And we see that the 30-year took it on the chin of the most. Around a 5% yield for the next 30 years, we don't think it's going to be the worst investment decision you can make, but there is a lot of volatility there. And so we're more geared toward the intermediate part of the curve. We're looking at about a 5 to 5.5% yield, and we're in higher quality parts of the bond market. Quality, again, in bonds is on sale on a relative basis because high yield spreads have tightened up again. And so when we look cross-asset, we actually do see the longer end of the curve isn't the worst decision. We're more in the intermediate. And again, being patient, getting paid income, and watching a lot of these narratives play out in the narrative merry-go-round of global markets.
It feels like we've been on that merry-go-round for a number of years now, Matt. Lisa was here yesterday, and she alluded to the following question. I think it's an important one. Typically, when everyone starts talking about bond auctions, and I mean everyone is talking about a 10-year and 30-year auction through the next 48 hours, usually we've reached an extreme. Usually things start to turn the other way. Do you think we're at that point going into the supply we get later this week?
Yeah, so we hit about 460 on the 10-year, and then we backed down. And it's around that 460, 480 levels that we've been more of a buyer and looking at opportunities there, and it has moved quickly. The whole narrative right now is focused on tariffs. No one is paying attention to the housing market, which is actually the biggest driver of inflation. It's 35% of the index. We're seeing housing slow dramatically in the United States. Supply is hitting the market in a significant way in California, Florida, Texas, and this is likely to weigh on housing. And if housing comes down, inflation comes down. If inflation comes down, the Fed is behind the curve. And we actually think them saying they're data dependent is not what they're doing. They're waiting to see what happens for the tariffs, which means they're not data dependent. That puts them behind the curve, and they're going to have to probably cut more than the market thinks in the back half because they've been waiting and waiting and waiting when they should be looking at the data.
Matt, put some numbers on that. When you say more than the market thinks, how much more? What kind of number of cuts are you looking for?
I think this year could be similar to last year, where it's back-end loaded, which is more hawkish relative to expectations, but then dovish in magnitude. So we think there could be 4 cuts at the back half. Right now, there's only about 2 priced in.
Matt Miskin of Manulife, John Hancock Investments. Matt, thank you, sir. Another 100 basis point of cuts later this year, according to Matt.
That's very far from where the market is. In fact, the market is under where the Fed's dot plot is. I think we only have 1 full rate price cut priced in, maybe about 77% odds that we would get to, but that's because the data has been better. Even the sentiment figures have started to be better, and the market has taken notice of that. So something would really have to turn to get it to 100.
Looking for CPI tomorrow morning, PPI after that. Yields a little bit lower this morning. We're down 3 basis points on a 10-year maturity, 4.4460. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. The Trump administration has deployed 700 Marines to Los Angeles to respond to anti-deportation protests. The state of California is suing to try to stop the deployments. President Trump backed comments from border czar